Hi. Welcome. Before I introduce myself, and with the purpose that all of us here understand, let me give you some logistical instructions regarding simultaneous translation to Spanish and Portuguese. I will switch to Spanish now. Primero, tendremos traducción simultánea. A lo largo del evento, estaremos utilizando el idioma inglés. Por lo tanto, para que elijas la traducción al español, la tarea es muy simple. En la parte inferior de su pantalla encontrará un globo terráqueo. Al hacer clic en el icono, escogerá el idioma de su preferencia. Verá las opciones de off, español o portugués. I will switch to Portuguese now. Primeiro, nós teremos tradução simultânea. Durante o evento, utilizaremos o idioma inglês. Assim, para que você possa escolher a tradução em português, a tarefa é simples. Embaixo de sua tela, você encontrará um desenho do globo terrestre. Ao clicar nesse ícone, você poderá escolher a linguagem de sua preferência. Você verá as opções off, espanhol e português. Now switch to English. First, I invite you to this event. The chat which meets the right of your screen. We will use it to send relevant information and useful links to everyone. At this moment, you'll see the link to Green Finance Slack, in which you will find all material, presentations, documents, bios of the panelists, which we will upload from here. I clarify that this webinar will be recorded and you'll be able to find it in the Green Finance Slack webpage. Well, my name is Rodrigo Porto. I'm a consultant here at the Inter-American Development Bank and your host this morning. We're convened today at the webinar, A Guidebook for National Development Banks on Climate Risks, an Innovative Agenda for Progress in Latin America and the Caribbean. It is the launch event of the Guidebook for National Development Banks on Climate Risks and also an opportunity to reflect and debate on this agenda forward. You'll be able to download the publication using the link available on the chat on the right side of the screen that will come up just after the Guidebook presentation. We'll have the chance to present the Guidebook later on. Let us begin with words from people who made this effort possible and will partner with the IDB in this journey toward more climate resilient entities. First, our sector manager at the Inter-American Development Bank, Mr. Moises Schwartz, then Mr. Carlos Linares, President of the Latin American Association of Development Financial Institutions, ALIDE, then Mrs. Susan Krohn, Head of Division International Financing for Climate Action and Environment Protection, German's Federal Ministry for the Environment, Nature Conservation and Nuclear Safety, and Mr. Thabo Tamani, Chairman of the World Federation of Development Finance Institutions and the Association of African Development and Finance Institutions. I now pass the floor for the welcoming remarks from Mr. Moises Schwartz. Good morning, Mr. Schwartz.
Thank you very much, Rodrigo. Good morning, good afternoon, good evening, everyone. Dr. Carlos Linares, President of ALIDE, Mr. Thabo Tamane, Chairman of the World Federation of Development Finance Institutions and the Association of African Development Finance Institutions, Ms. Susan Krohn, Head of Division at the German Ministry for the Environment, Nature Conservation and Nuclear Safety, representatives of national development banks, local and international financial authorities, ladies and gentlemen, welcome. It is an immense pleasure to open today's meeting, which has a twofold purpose: to present the new IDB publication for national development banks on climate risks and to discuss with relevant stakeholders and partners from the international financial community the additional steps to an innovative and collaborative agenda for the sector, looking at the progress of the economies of Latin America, the Caribbean, and other regions of the world. COVID-19 has inflicted considerable pain in Latin America and the Caribbean, both economically and socially. Owing to the pandemic, the region's economies contracted by an estimated 7% in 2021, the sharpest in the world. In these truly exceptional times, the Inter-American Development Bank Group approved a record of $21.6 billion in new financing. These measures have not only increased resilience and adaptive capacity, but also laid the groundwork for a sustainable and climate-smart recovery. Early economic indicators in 2021 are showing that countries in our region have managed to bounce back and that the long-term sustainability focus is showing positive results. We need to make this the clear and unstoppable direction of travel now. We cannot go simply back to the old models of recovery. This is our opportunity for change to make the COVID-19 recovery truly climate smart and resilient. In fact, as recently emphasized by both the G20 and G7 countries, there is a great potential for promoting a transition towards a greener global economy. As stated by the People, Planet, and Prosperity pillars from the G20 presidency, and the commitment to beat COVID-19 and build back better, and to put global ambitions on climate change at the center of their plans from the G7 meetings. National development banks, NDBs, are key actors for climate-smart recovery. Besides their important role in supporting countries and businesses in the COVID crisis, NDBs have been instrumental during the last decade in helping governments to green their economies. They have taken a leadership role based on their public development mandate to develop innovative financial solutions for low carbon and climate resilient investments. At IDB, we are working with NDBs to help shifting the trillions of private investments to low carbon and climate resilient pathways. We are designing and deploying innovative financial instruments for the de-risking and crowding in of private capital in different sectors, including for SMEs and sustainable infrastructure projects. IDB's Green Finance Partnership with more than 40 NDBs in the LAC region has financed over $2 billion in credit line programs and leveraged more than $6 billion in green private investments to date. Furthermore, IDB partnership with the ALIDE gives it access to a network of 72 NDBs in LAC, which have $1.7 trillion in assets, a portfolio size of about 1 trillion, and more than 78,000 branches in urban, rural, and otherwise unbanked regions to drive the green transition. Activities with NDBs on climate change and green recovery is one of the strategic axes of IDB's Vision 2025 and is aligned with the IDB's group plan to accelerate economic recovery and promote sustainable and inclusive post-pandemic growth. Enhancing NDB's ability to identify, assess, and manage climate-related risks is therefore relevant to build macroeconomic and financial system resilience. Is it also relevant to build in-country capacity to identify and mitigate climate risks and align financial flows with the Paris Agreement? Physical and transition risks manifest through and are drivers of conventional risk types of financial institutions. Credit, market, capital, operational, and reputational risks, posing material financial risks. NDBs are potentially exposed to climate-related risks and opportunities through their lending and other financial intermediary activities and through their own operations, particularly as they provide medium and long-term finance to capital investments. The way NDBs originate and structure projects and handle climate-related risks influences their ability to fulfill their development mandate. Therefore, the need to further scale up NDB's capacities and assessment to mainstreaming of climate-smart investment policies and practices and financial disclosures related to climate risk as outlined in the IDB's Climate Risk Handbook. In this context, at IDB, we consider it key to broaden the coalition of supporters to further mainstream green finance and climate risk mitigation in the LAC region. IDB has created the networks to bring the major players to the table, but we need an important collaborative effort to bring the sustainable recovery in the region to scale. Today, we have the opportunity to move decisively towards a cooperation agenda with development banks, hand in hand with international partners such as OECD, the Climate Policy Initiative, and bilateral development institutions such as the French Development Agency and Germany's KfW. In the next minutes, we will discuss pathways to support banks and governments with the mobilization of national and international capital as they are necessary to address the socio-economic implications of the COVID-19 pandemic and climate change. Moreover, the IDB and representatives of international initiatives, such as TCFD and the United Nations Environment Programme Finance Initiative, as well as academia, will analyze the climate risk agenda and future perspectives to support the decision-making process from the development finance sector perspective. This is the beginning of a long journey for IDB and partners, like the International Climate Initiative from Germany's Federal Ministry for the Environment, Nature Conservation and Nuclear Safety, that has provided immense support for this project so far. We count on the development banking community and market associations to travel together with us towards sustainable growth in Latin America and other regions of the world. This includes ALIDE, the World Federation of Development Finance Institutions, and the European Long-Term Investors Association that are also joining us at this event today. I invite you to take advantage of this scenario to talk and debate, and hope we all have a very productive meeting. Thank you very much.
Thank you, Mr. Schwartz, for your words. Now I invite Mr. Carlos Linares, President of ALIDE. Thank you for being here with us, Mr. Linares, and good morning.
Thank you. Good morning. Mr. Moisés Schwartz Rosenthal, Sector Manager, Inter-American Development Bank. Mr. Thabo Tamane, Chairman of the World Federation of Development Financing Institutions and the Association of African Development Financing Institutions. Ms. Susan Kron, Head of Division, International Financing for Climate Action and Environmental Protection from the Germany's Federal Ministry for the Environment, Nature, Conservation and Nuclear Safety. Colleague from the Development Bank of Latin America and the Caribbean, ladies, gentlemen, or friends. I would like to begin by expressing, as President of ALIDE, our gratitude to the IDB for taking part as a strategic ally in this launch event of the Guidebook for National Development Banks on climate risks, which seeks to provide a roadmap for the integration of climate-related risks and opportunities, at the same time as it is an opportunity to convene strategic partners, international standards bodies, and the global development bank community to discuss the role of national development banks in addressing climate risk and opportunities. In the current situation, faced with a need for sustainable recovery, coordination and cooperation efforts with international financial institutions are essential to achieve both the objective of the Paris Agreement and a path of long-term sustainable development. The impact of the health crisis caused by the COVID-19 pandemic, coupled with the environmental crisis, has amplified the economic crisis and the amounts of investment needed to preserve the decades of progress in socio-economic issues in Latin American countries. Overcoming the so-called triple crisis presented simultaneously has become clear that we must address it collectively and on a global scale. In order to achieve the common objective, therefore, it is important to accelerate efforts and increase their scale. This is one of the main opportunities where it is observed that the national, regional, and multilateral development banks at the global level play a fundamental role especially in Latin American countries and also all over the world. The national development banks will play a very important role in a transformation and transition towards increasingly sustainable growth. It is therefore essential to further link its actions with sustainable development. Nicholas Stern, author of the famous 2006 Stern Report on the Economics of Climate Change, in a dialogue with then IDB President Luis Alberto Moreno in May of 2020, said that the evidence clearly showed that long-term climate-friendly stimulus policies can be very effective and support a rapid recovery, create jobs, and lead to greater investment and innovation. Therefore, for development banks committed to environmental financing, they have now an opportunity to support a sustainable recovery. Support for energy efficiency, renewable energies, sustainable infrastructure, sustainable agriculture and tourism, ecosystem conservation, bioeconomy, urban development are objectives of all these institutions. Tools such as the Guidebook for National Development Banks on Climate Risk, which will be presented on this occasion, are of great value to development financial institutions for develop their activities in building developed economies and sustainable bases. We, as well as IDB, hope that the use of these tools in our financial institutions will help to strengthen our capacities and support them in the integration of climate-related risks into our activities. Thank you very much.
Thank you, Mr. Linares, particularly for the valuable cooperation with the IDB on this Guidebook project. Appreciate it. Now I pass the floor to Mrs. Susan Krom, who represents the International Climate Initiative of the German government and has also been a long-time alliance supporting climate projects in Latin America and the Caribbean, like the Guidebook itself. Thank you, Mrs. Krom. Good morning, or maybe good afternoon.
Thank you very much, Rodrigo, and good afternoon from Berlin. Good morning to Latin America, and maybe also good evening to some of the colleagues. It's a great pleasure to be with all of you here today at the event to launch a guidebook for NDBs on how to integrate climate change considerations and risk into financial planning and decision-making. The financial sector will play a decisive role in limiting the global temperature increase to 1.5 degrees centigrade in line with the Paris Agreement. It needs to shift its portfolio from fossil fuels and other carbon-intensive activities towards climate-friendly financial investments. The mothers and fathers of the Paris Agreement were convinced about the critical role of the financial sector in addressing the climate crisis. Next to the goals for mitigation and for adaptation, they included into the objectives of the Paris Agreement a specific goal for financial flows. Article 21C of the Paris Agreement requires countries to make all financial flows consistent with a pathway towards low carbon and climate resilient development. Achieving this is undoubtedly a challenging but necessary task. One key factor that incentivized the financial sector to consider climate change in its investments are the risks associated with it. For many years, these risks were mostly disregarded. Unlike traditional financial risk factors, for instance, market price risks, climate risks were and are harder to assess and to incorporate into decision-making. However, neglecting them can come at a high price for the climate, but also a high price for the investor who may be faced with the situation that his investment does not deliver the expected returns due to climate change and has turned out to be a stranded asset instead. In the last years, tools were available for climate-related risk assessment and disclosures. They have developed and expanded rapidly. International financial sector initiatives for instance, the Task Force for Climate-Related Financial Disclosures, the TCFD, are advancing systems to transform the financial sector in multiple regards and have already shared important recommendations and lessons learned. Due to their public mandate, national development banks are uniquely positioned in the finance sector. They are responsible for supporting sustainable development pathways of their countries. And most recently, they have played a key role in responding to the impacts of the corona crisis. They also have the potential to play a key role in building back better and greener after the crisis. Next to providing finance themselves, they cooperate with other financial actors. Here they can lead by example and guide other institutions through their principles of investment. By doing so, they can have a substantial impact on the financial sector as a whole. Nevertheless, integrating climate change considerations and risk into decision-making processes is a complex undertaking. It requires the appropriate institutional setup. It requires capacity and knowledge to define metrics for risk assessment and incorporate them into an overall risk strategy. The Guidebook for National Development Banks on Climate Risk we are launching here today provides guidance for these banks on how to implement existing recommendations and lessons learned on risk assessment and disclosure. By laying out a roadmap on what steps to take, the Guidebook presents a helpful toolbook for NDBs in identifying how climate risk may affect their investment portfolios and what can be done to limit the exposure of risk of climate change on their operations. The Guidebook is a key outcome of a joint and from my experience and perspective, excellent cooperation between the IDB and the German Ministry of Environment, which is my ministry on green finance. And it is one area of support under our International Climate Initiative. I'm very much looking forward to the discussions here today. And last, but definitely not least, I would like to send a warm welcome from my side to all participants. Thank you very much.
Thank you for your words and support of this matter, Mr. Krohn. Now I want to call Mr. Tamani, who represents a large population of NDBs through the World Federation of DFIs, Development Financial Institutions, and the Association of African Development and Finance Institutions. Thanks for accepting our invitation to join us in this debate. Mr. Tamani, good morning, or maybe good afternoon too.
Thank you, Rodrigo Porto. It is a good afternoon in Botswana, all the way. I'm here in Botswana. And before I present my remarks, I would just want to say to all of you that, once COVID is done and dusted, I'm inviting you to come to Botswana to witness the Okavango Delta, where you have the pristine, untouched, wetland, where animals and people coexist. Please do find time to Google Okavango, and I'll gladly host you when you are here. Good people, let me recognize everyone as per the National Order of Precedence and as per protocol in the interest of time. And welcome everyone to the launch of this exciting and innovative Guidebook on Climate Risk. And I've been listening to Susan, how she has unpacked, some of the intrinsic benefits of, the Guidebook. And I'm looking forward to having a copy and making sure that my constituents, which is the World Federation of DFIs, the Association of African DFIs, and indeed my own DFI in Botswana that I'm the CEO of, would basically implement. And I've already been introduced, but for those that may not be familiar with us, the World Federation is an umbrella association of continental, regional development finance associations. That is the African one, the Asian Pacific one, and the Latin American Association, and and the Association of National Development Finance Institutions in member countries of the Islamic Development Bank, and the European Long-Term Investors Association. So it's a large population, and it's in the captive market Susan, for really making sure that this guidebook is actually taken up in large numbers to enhance climate finance and managing the risks of climate finance. Together, we aim to promote development as a unified force, facilitating knowledge exchange, capacity building, and enhanced cooperation between DFIs across the globe. While much of the world is still grappling with the fight against COVID-19, we are starting to see a glimmer of hope. We must always have hope. As the vaccines roll out, lockdown measures are being reduced in certain areas, and businesses begin to reopen. And now Biden is in Geneva with Vladimir Putin. We hope that the discussions and relations will improve, amongst others. And we've been waiting for so long for things to get back to normal. But in truth, I believe things will never be the same again. And we have to adjust to the new way of living and doing things. The pandemic has exposed many gaps in our system, and we have less than 10 years left to achieve the SDGs. And now is the time to look ahead, not back where we once were. We can only learn from the experience of the history. If we must rebuild our infrastructure and our economies, why not do so in ways to forge the path to a better and more sustainable future by adhering to better ways of climate finance and managing climate risk? Ladies and gentlemen, I cannot overstate the importance of building back better or the importance of addressing climate change specifically. Climate change is not going away. In addition, the risks arising from climate change are prevalent. Droughts, floods, hurricanes, raised temperatures, and all this can cause significant or even devastating disruptions to our societies, businesses, and economies, as it has been stated earlier by Susan. They can disrupt supply chains and cause damage to assets, among other market disruptions. Some sectors may be more sensitive to the impacts of climate change, but no sector is completely immune. This will inevitably threaten the stability of the financial system, and therefore it is imperative for the financial sector actors like ourselves to intervene, and not only do that, to take action, because if you don't do that, history will judge us very severely, very, very severely. National development banks, as public policy instruments, must play an important role in managing climate change. These NDBs are actually at risk to climate change than their commercial counterparts, as they may have sector-specific mandates for industries that are especially vulnerable to the impacts of climate change. NDBs must be proactive in addressing climate-related risks to enhance their own resilience and the resilience of their clients. They must enhance their access to climate finance and play a leadership role in supporting local financial institutions through knowledge exchange, among others. Our actions today will determine the frequency and severity of impacts in the future. The World Federation of DFIs, which I'm proud to be the chairman, believes the development finance institutions can and should play a critical and crucial role in addressing climate change through carefully assessing and managing climate-related risks in their portfolio and deploying capital towards rebuilding a low-carbon economy. Because of this, we are delighted to be here today for the launch of the IDB's Guidebook for National Development Banks on climate risk. Our hope is that this guide pushes NDBs to take an action in identifying, assessing, and managing the risk associated with climate change to better align their strategy and deliver on their mandate. I'm looking so forward to hearing from the speakers today, and I wish you all a fruitful deliberation, as I know that what we will take away from this session will propel us to greater heights. Obrigado, muchas gracias. Thank you very much.
Thank you, Mr. Tamani. This is a challenging and collaborative effort indeed, and we appreciate for your presence and your enthusiasm to join us toward this journey with the NDBs. Following up, I want to introduce Professor Stephanie Griffith-Jones, our keynote speaker. Stephanie is Financial Markets Program Director at the Initiative for Policy Dialogue at Columbia University, Emeritus Professor, Fellow at the Institute of Development Studies, Sussex University. non-resident fellow at the Center for Global Development, Washington, D.C. Mr. Griff Jones is responsible for researching and providing policy advice on reforming the international and national financial architecture with recent emphasis on development banks. Mr. Griff Jones, thank you for being here with us.
Thank you very much. I'm very honored and delighted to be addressing this important meeting. And I thank very much the IDB and Rodrigo and Maria in particular for having kindly invited me. So my presentation will be called The Future of National Development Banks and the Green Recovery. If I may have the first slide. I want to start with some brief theoretical insights. There's been in recent years a real renaissance of a belief in development banks and growing importance. I would state this since the so-called North Atlantic financial crisis of 2008-2009, and even more so in COVID, because very clearly the valuable role that development banks can play in a counter-cyclical aspect, but also in structural transformation, has become more and more evident. And I think the theoretical aspect can be actually very simply but powerfully presented by an analysis that Joe Stiglitz did, where he stressed that financial markets have more market failures than government failures. So it's not a belief that governments are perfect, but that they have less failures than markets in the financial sector. And I think one can add in the context of our discussion today that there are also important market failures in creating a low carbon economy. Because, for example, there are significant externalities, there are uncertain returns in creating such a large structural transformation to sustainable development. And therefore, we are dealing, if you like, with two sets of market failures, those in the typical of financial markets, but also those typical in this structural transformation to the low carbon economy. So I think because there are these restrictions for private finance acting on its own, the role of development banks at the national, regional, and global level becomes particularly important. If I may have the next slide, please. So the case for development banks can be made from the limitations of private finance when it acts on its own, in aspects like lack of sufficient long-term credit, scarce and expensive lending to, for example, smaller and also newer innovative companies, and its unwillingness to fund key development projects which have high uncertainty. And I think it's important to distinguish between uncertainty and risk, as Frank Knight did in the 1920s, because risk can be measured or can be tried to be measured quantitatively. But uncertainty, we don't know anything about what will happen in the future. For example, we cannot expect a big pandemic like COVID in advance, and therefore uncertainty is very difficult to evaluate and therefore to price. And markets hate uncertainty. So we have currently facing this difficult situation where we have uncertainty, which increased so much in COVID times, plus the urgency of meeting the needs of the climate transition due to the climate emergency. I was recently at a seminar where people were saying, oh, you're demanding too much from these institutions. I was discussing some development banks. And the problem is that one is not demanding too much per se, but demanding so much because the emergency is so large. The transition, as was said before, to a low carbon economy just cannot wait. So a problem, therefore, is how to deal with this major new challenge. And one example that I would like to present from a European perspective is the case of the European Investment Bank, which I have had the opportunity to study, and which has become a green or a climate bank, and has committed to 50% of new lending since 2025. And the rest of its lending is also compatible with, is aligned with the Paris Agreement and the Paris commitments. I want to mention this a little bit more afterwards, because I think there are interesting lessons to be learned from development banks. The other case, of course, is that during crises, whether they're financial or now COVID, private institutions tend to reduce lending or increase it very little in pro-cyclical way. So that provides a case for development banks. If I may have the next slide, please. So there's a positive case for development banks, and I would like to stress that they have not only key roles multilaterally, regionally, and nationally, but they actually already are very big actors because they fund about 10% of global investment, which represents over $14 trillion of assets and $2.3 trillion of annual lending. And as you know, better than me, NDBs are active in developed, emerging, and low-income countries. In fact, NDBs are very large, for example, in Europe. And there's been an impetus given, of course, to development banks by the creation of AIIB, by the NDB, the BRICS Bank, plus a dramatically increased role of the European Investment Bank. And I would like to highlight the very likely creation of a large US green bank, which there is a bill now in the Senate, approved already in the House of the US, which would involve creating a green bank with a capital of $100 billion, if it happens, which should happen very soon. And so therefore, this is an additional, I think, impulse to development bank activity in the green field. I think it represents also a balanced approach, a sort of combination of public and private institutions, public and private collaboration. And the debate is a little bit how to structure that collaboration in the best possible way. There was a time when there was a lot of debate of markets versus states. I think that time is a little bit past, and we have to be pragmatic to see what works best and what delivers best for green development. And I think a very attractive feature is the valuable leverage, of course, that NDBs provide for scarce public resources and the long-term funding, as NDBs, over 50% of their loans are over 10 years, which is absolutely crucial for investment, for example, in the green transformation, which requires these kind of long-term horizons. So if I may have next slide, please. So the key roles for development banks, which we sort of defined in this book, which we co-edited with Jose Antonio Campo, was firstly to provide countercyclical finance, help provide finance for structural transformation, help deepen local capital markets, particularly for instruments that are valuable for development, like local currency and green bonds, support greater inclusion, and finally, finance global public goods, particularly climate mitigation and adaptation. And now we have this new challenge of combining, as it was referred to already, post-COVID recovery and ensuring it is aligned with green objectives. And I think this is a marvelous opportunity, but it also poses challenges and trade-offs because there is always the temptation to save companies and jobs, which is of course very valuable, even if they don't contribute to the green transition. So I think the work that the Inter-American Development Bank and the National Development Banks are doing worldwide is very important in this area, but one has to give thought to how best combine these two very urgent objectives and not to do one at the expense of the other. If I may go quickly to the next slide, please. So in terms of counter-cyclical lending, both national and regional and multilateral development banks have played a big role in the 2008-9 crisis, with the national development banks increasing lending by 36% in 2 years, based on World Bank data. And I think they have also been key in COVID times. And I think the data is being gathered, but I think there are very impressive achievements, including in the IADB, which was mentioned by Mr. Moses Schwartz. And they have been crucial in helping maintain long-term investment during the crisis, because that's one of the most damaging things that long-term investment tends to get, partly because of lack of finance, tends to get reduced. But also more specifically, they have helped to maintain jobs and prevent insolvencies. And this counter-cyclical role of NDBs is a complement to counter-cyclical fiscal policies. I think in Europe, after the Eurozone debt crisis, for example, the actions of the European Investment Bank and national development banks, to a certain extent, it seems to me, replaced a necessary Keynesian fiscal policy. But today, for example, in Europe, in the United States, and in the more advanced emerging markets, the activities of the increase of lending by national development banks in a counter-cyclical way complements the increased spending through fiscal means. And this is particularly true, of course, in developed economies which have more fiscal space, less clear in countries like in Latin America and Africa, which do not count, unfortunately, with so much fiscal space. I think it's key that development banks have enough capital in normal times, so they can already respond quickly in event of crisis. And I think this is a very important factor, which I would argue is also very relevant for the Inter-American Development Bank and other regional development banks, as well as the World Bank, which is to have the sufficient resources and sufficient capital so they can respond as quickly as possible to the needs of recovery, as well as to the needs of the green transformation. If I may have the next slide, please. So perhaps closest to the interest of this conference, development banks can play and do play a key role in funding structural transformation. They can foster real innovation and entrepreneurship in national economies. And they're essential because there is this need for a major transformation to move not just to a greener transition, but also a more inclusive transition. And they contribute to this, of course, by having patient, long-term committed finance, funding new sectors or cross-cutting sectorial programs with high uncertainty. And because there are major externalities, of which the green economy is an example, they have special tools like the shadow price of carbon. And I would like to say just a few words about this. In the case of the European Investment Bank, they have used the shadow price of carbon for over 10 years now. And they have put it at a very high level. This year, the shadow price of a ton of carbon is now 80 euros, a major increase over last year when it was 30 euros, and of course, much higher than the market price of carbon. And they have ambitious aims of getting an increase of the price of a ton of carbon up to 800 euros in 2050. And I think then this price is used for a sort of shadow evaluation of projects. And if the shadow evaluation with this higher price of carbon is profitable, there is a very strong incentive for the bank to fund this project. And I've discussed actually with one of the panelists today, with Diana Smallbridge, the idea that it might be very interesting for other development banks to use such criteria, and also for the Latin American region to think of instruments like shadow price of carbon at the national level to evaluate projects. It has, of course, the implication that if the project is not so commercially viable, it may require some kind of public support to make it commercially viable. But it gives very clear signals, I think, and I think that these instruments are very, very important. If I may have the next slide, please. And finally, of course, there is a need to finance global public goods, where development banks, and I don't really need to say this in this audience, national development banks or regional ones have the advantage of accumulated expertise, administrative efficiencies, and very importantly, convening power, which is so key. And development banks can not just help fund the green transformation, but they can help governments design policy frameworks for green transformation. And we studied the cases of China and Germany, for example, and both countries helped design the framework, for example, for investments in renewable energy. And those countries played absolutely key roles. First, Germany, and which introduced solar, mainly thanks to the funding that was provided by KfW, together with the framework that the government provided. And then the Chinese took over using the large scale of their economy and of their development bank, and managed to produce solar panels at a radically reduced cost. So there were benefits not just for the German and the Chinese economy, but I would say for the whole world, because now solar energy has become so much cheaper than it was, and in many regions, as you know, is cheaper than fossil fuel. So there was, if you like, a major externality which was provided for the rest of the world, and which the development banks played such an important role, and where they really showcase the viability of having this renewable energy. If I may have this next slide, please. So I would conclude in this section with the argument that there is a greater need for MDBs, RDBs, NDBs than ever. And I think the important question to ask for, say, Latin America and Africa, whether the current scale of NDBs is large enough for the development needs of green transformation, plus the COVID recovery. And looking again at the case, for example, of Germany and China, but also other countries, we can see that they have very large NDBs in proportion to their GDP, much larger than, say, most of the Latin American development banks. And at the same time, we're facing a problem of very low levels of private and public investment in the Latin American region, especially post-COVID. It is hard to increase public investment. It's desirable, but it's hard because of the limited fiscal space. And it's hard to encourage private investment without policy interventions because of the problems of uncertainty and lack of private finance. So therefore, the possibility of leveraging public resources by NDBs, particularly those that can borrow on domestic or international markets or get international resources, is very important. And not just in sort of theoretical development terms, but also in practical terms, doing what the Europeans like to call doing more with less. So because we have this need, as I said, to higher investment for both recovery and structural transformation, which has to be linked to the need of a more dynamic, greener, and smarter, plus more inclusive model, I would conclude that national development banks and regional development banks are needed on a significant scale and possibly larger scale than they have today. If I may have the next slide, please. I have too many slides. Amongst the conditions for NDBs to operate well, I think it's important that the broad context in which they operate, including macro policies and well-functioning financial sectors domestically, function. And countries may have a very good development bank, but if the domestic environment is not good, then it's much more difficult to perform well. I think also very important is for the country to have a clear development strategy focused on a green and just transformation, and very clear policy mandates for the NDBs. And it's better if they don't change much with different governments, are not subject so much to political shocks, but they only change if the needs for development of the country. And I think KfW is actually a good example where different political parties have, with certain nuances, of course, of emphasis, but have always supported KfW. And that, I think, facilitates a more long-term perspective and a more efficient delivery. And I would like to stress here that the IDB Guidebook, which is being launched today, will actually be very valuable in helping NDBs increasingly green their operations and take account of climate risk. So it will be a very positive contribution. The next slide, please. And I finish here. I bring the policy recommendations from the Paris Summit, which convened all development banks, all 450 development banks, both national and multilateral. And so some of the policy recommendations where we summarized all the research that was done in 16 papers, which are actually available for anybody who's interested. So the first conclusion I've already made, it was to make sure capital is at sufficient scale, in proportion to the needs. Not in absolute terms, which it may be, but in proportion to the needs. Secondly, that development banks should incorporate a transition to low carbon and fair economy in all financial decisions and in all stages of the project cycle. I think that is a very important challenge, which is also mentioned in the guidebook, to blend resources with the private sector in the most effective way to achieve development targets, to help channel private finance to meet the development needs and the green needs of the economy. That it's very key for NDBs to have independent and strong governance. And finally, last but certainly not least, to choose instruments which maximize development impact. And I would like to just briefly refer to that and emphasize that development banks, I think, should not be profit maximizing, though of course they have to make profits, which are valuable, not least for increasing future capital and reserves so they can continue to expand their activities. They shouldn't be profit maximizing. What they should aim to maximize the impact on development, on green and inclusive development. And that, of course, needs the creation of matrices to help do that. And I think that there is, for example, I don't have time to talk about this. I've done several papers on this. I think there may be perhaps a bigger role for direct instruments. If we are trying to achieve certain aims, the role of direct instruments like direct lending and also equity may play an important role for several reasons. One of them being advantage of allowing the bank, working jointly with the government and the private sector, to give greater policy steer, to try and channel resources towards the priority sectors. And I think particularly in the case of equity and venture debt, besides this advantage of policy steer, it's very important now in COVID times because companies in Latin America, Europe and Africa, everywhere have been borrowing a lot in times of COVID, and they're extremely leveraged. I think the levels of debt in companies is very worrisome. So in helping them generate more equity and supporting this is very valuable. And finally, there are instruments like quasi-equity, like venture debt, which is a loan by development banks like the EIB, for example, which has an equity kicker and therefore can be converted into equity, has the advantage that the development bank cannot just share the risks, but also share profits. So if a company becomes very profitable as a result of a loan from a development bank, those profits can be shared with the development bank, which can then use that those funds to continue taking more risk. And I just want to finish on a positive note, saying that a good example of this venture debt is the loan that the European Investment Bank made to a little company called BioNTech, which has now done the research for the Pfizer-BioNTech vaccine, which again is an example of a public good that a development bank generates. Thank you very much for your attention.
Thank you. Thank you so much for your notes, Ms. Griff-Jones. We inform you that Ms. Griff-Jones and the IDB are developing a blog, which will be placed at the IDB website, and will provide information about our view of the future of NDBs in supporting governments and key new sectors that are crucial for sustainability in the post-COVID recovery economy. Very soon, we will communicate with you through IDB's institutional channels to let you know about the launch of this blog. Appreciate your attention. Now we're quickly heading to the session in which we will present our guidebook for NDB on climate risks and the rationale for this initiative from the institutional view of the IDB. We are happy to have Ms. Maria Neto and Mrs. Diane Smallridge in this session. First, I want to introduce Ms. Maria Neto, who is Principal Specialist in Capital Markets and Financial Institutions at the IDB, and is responsible to oversee programs for innovative financing strategies with local financial institutions and capital markets in Latin America and the Caribbean region. Maria, good morning and be very welcome.
Thank you very much, Rodrigo. It's a pleasure to be here. It's a pleasure to be here from the Inter-American Development Bank with so many friends and colleagues. My presentation is going to be a bit of a bridge between what Stephanie was talking, which is the overall role of national development banks and the green recovery, of course, in our case in particular for Latin America, but why we think this handbook is part also of this new mandate and the importance also of the role of new development banks towards the future. Of course, starting with like what is our situation, Latin America and Caribbean was particularly hit by the economic crisis from the COVID-19. IDB has provided more than 21 billion in support for the let's say, a short-term response for the crisis. But I wanted to highlight that from this 21 billion, more than 3 billion was actually with national development banks, and that the national development banks had a huge role to play last year as counter-cyclical kind of mechanisms, particularly for small and medium enterprises, but also for many activities of the countries to continue to operate and for maintaining jobs. At the same time, as many of you mentioned, we are in a situation of, build better in the future and dealing with crises and needs for investments that existed before the COVID crisis. Latin America and Caribbean has a huge gap of investments for infrastructure. We in IDB have estimated around 150 billion needs for investments for the proper growth of the region. And on the top of it, we have the need for these investments to be sustainable and have additional opportunities for these investments to take place. However, these investments are huge and cannot be done only by traditional fiscal kind of solutions and require finding financial solutions that can leverage with public resources, private investments. And I think here, one of the key issues to discuss is how can we support national development banks to be these vectors and working with MDBs like us to develop financial solutions, innovative approaches, de-risking instruments that can leverage these investments. The region has a huge potential in terms of sustainability. It is the largest biodiversity, for example, percentage of, let's say, natural resources. We have 40% of it. We have a huge potential also with a very large, let's say, renewable energy matrix with potential for new technologies like electric vehicles, green hydrogen to be developed towards the future. And these opportunities bring also a lot of win-win opportunities in terms of creation of jobs, productive growth, and also, if well structured, reduce the fiscal stress of the governments that have been enhanced further with the COVID crisis. As actually Moises mentioned, the national development banks in Latin America actually today own 1.7 trillion in assets. These national development banks have been operating in all sectors and different types of parts of the economy, urban or rural, from infrastructure to small and medium enterprises. And they have this very specific and unique mandate to develop basically what the governments want to do in terms of policies and responses for what they want to do, including for Paris. We at IDB have bet very strongly in national development banks for over 10 years to support precisely the governments in the region to promote private investments in green and sustainable investments. We have worked with over 40 of those national development banks, and actually we were able to leverage over $6 billion in investments in green finance. So we do see already national development banks doing a lot. However, the question is, what next? We have a lot of innovation. A lot of those banks have done a lot of instruments and are committed to do more. However, and I think that is the main question, and a bit of Stephanie's discussion was this, we need to bring about a discussion of how to green the banks as mainstreaming the issue as part of the institutional capacity of the banks, beyond just some instruments and initiatives that the banks are restructuring. And why that? This is because climate change, it's an issue today. It is an urgency, and is an urgency in terms of costs, not towards the future. The impacts of climate change, unfortunately, today already have a cost. However, indeed, if we don't do, in addition, today, something, the costs of inaction are going to be much, much, much higher than the cost of action. And our region is particularly vulnerable to climate change. This vulnerability has affected the financial systems and has brought a new kind of debate. We have in the region and overall a discussion that has been happening already about the responsibility of the financial systems to integrate environmental and social impacts. And this has been increasingly being concerned as an important issue of transparency and good governance that actually was very interesting to see during COVID. Most of the assets and the funds and so on that value ESG start actually seeing these as good practices and governance and transparency in general as well. But independently of this, the climate crisis and the climate risks bring an additional, let's say, concern, because they are environmental externalities. It's not just the impact of an investment in environment, it's the impact of environment in the investment that lead to the need for corporates, for sovereigns, for financial institutions to start understanding what this means for them today and in the long run in terms of assets and their whole portfolios. It's not anymore about just some initiatives here and there. It's about how I, development bank or financial institution, have a role to play in terms of ensuring that everything I'm doing is not going to cost to me more or have an impact in the system. In Latin America, we have actually that kind of conscience being growing from the regulator's point of view. And here we have a small video that once we distribute the presentation, we can show to you more in detail. But it's actually very exciting to see that from 1995, when Brazil had a first green protocol from the banks, from the private sector, so bottom up, we ended up having so many initiatives that are happening today in all sorts of kinds of regulators in the market, banking regulators, central banks, but also the Values Commission, the pension funds regulators, and the insurers. Why this is happening? This happens, of course, because worldwide we have a strong push to start understanding precisely that these climate risks and impacts that are already happening today and are unfortunately predicted to be very high could actually destabilize literally the financial systems. And that's why we have been having initiatives worldwide where the Latin Americans have been very active already. And we are going to have some discussions today about that, where basically we are trying to see what are the good practices to promote disclosure, governance, and actually the mainstreaming of these in the financial systems. And in Latin America, IDB has been very committed with the regulators. We are going to listen about that today as well, with a new initiative, Redes, between all the regulators of the system. At the same time, just the last weeks, we have been hearing a very strong push again, and that has a lot to do also with the Paris commitments of saying we need to actually promote more mandatory climate-related financial disclosures because we need to start understanding better what's really happening. And we need to promote the standardization of that. No? Now, I want to just take a step back here because we are going to talk about the handbook after. And I think one of the main challenges for not only national development banks, but for the financial systems in Latin America, is that how we actually develop actual tools and capacity for the banks to start mainstreaming these issues of climate change in their businesses. At one hand, because they need to manage better their assets, not to lose their actually resources and be exposed, but also because they have obligation and opportunity to promote financing for adaptation, financing for initiatives that can promote lower carbon and deal with what Susan was saying, how this can become an opportunity also to leverage these private investments that the Paris Agreement need for reducing also the impacts of climate change over time. Unfortunately, we still see in our region a very low and small participation to this global trend and even the regulatory trend from the financial players themselves. And why is that? Partially because of the lack of tools. We do realize that a lot of the tools and methodologies developed initially looked a lot, for example, at infrastructure. Our region, for example, has a very strong role of agriculture, for example, when we talk about climate physical risks. Also, we see that the discussion needs to be translated to the local conditions and the crisis that we are coming out. And so we need to develop tools that help the financial institutions to be able to understand what these risks mean for them. In addition to that, we also need to support institutionally financial institutions, and in particular the public banks, to develop processes that can allow them to slowly develop their goals and become greener and become green banks, as Stephanie was talking about. This makes sense for the national development banks. I think that Diana is going to dig in a bit to give the idea of what we have with the handbook. The handbook comes out of a survey we did with the national development banks. And what we saw with the survey was precisely that on the one hand, there was a huge interest from the banks, but it's still a lot to be done in terms of institutional capacity. And also what became clear from the analysis we did is the relevance and the importance for them to have leadership on that, not again because they do have assets they have to protect that are to be used for better recovery, but also because they have a responsibility to finance adaptation and mitigation and support de-risking and new and innovative financial solutions that can reduce precisely the, let's say, exposure of our region. And in the world is the same, because the national development banks in other places should be doing the same, actually reduce the exposure to climate change. In this sense, the guidebook is a first step, and that's what I want to be very clear. It's a first step of a long-standing work we have been doing IDB with ALIDE, and I want to thank again ALIDE for this event and to work together with them. Is a long-standing work we have been doing, as I said, over 10 years with national development banks in promoting green finance. Is a handbook, so is an idea of what is the roadmap we need to start thinking of for greening the banks and for integrating these climate concerns in the work of the banks. However, is an initial step, and that's why we think it's so wonderful to be here with so many partners, both the, other partners like us, like KFW, Agence Française de Développement, that have been doing this kind of programs, partners like Climate Policy Initiative, the different partners here also working with DFIs, and all the partners also working on how to promote these tools for methodological ways to mainstream that towards the NDBs, because in our view, this agenda needs to move on further with the development of specific tools, with examples of how we can demonstrate that for different sectors. Climate risks and climate responsibility is very different if a public bank has the obligation to finance infrastructure, subnationals, agriculture, and or micro, small, and medium enterprises. But all of these sectors, again, are key for the recovery of the region and for achieving Paris Agreement. We also think it's important to support good governance and have a common language about that around the public bank. So for us, this is a moment to position also the beginning of an agenda that we hope is a collaborative one with all of you. And I wanted with that, Rodrigo, to pass back to you so that we can hear more about this handbook and the beginning of a roadmap that we are trying to develop here. Thank you.
Thank you, Maria. I now pass the floor to Ms. Diana Smallridge to present the guidebook. Thank you, Ms. Diana.
Thank you, Rodrigo and Maria. I'm absolutely delighted to be here to share this important piece of work. I note that it's been dropped into the chat box, the connection to the actual guidebook itself. But my intention is within a short period of time, just to give some key highlights of the guidebook. And so you can take this forward. I really believe that national development banks are the unsung heroes in the climate journey, and with the proper internal capacity and expertise that Maria was speaking of, as well as Dr. Griffiths-Jones, they can really help fight nationally the climate risks that we're speaking about, and their position within the climate finance landscape can be highlighted. So building on what Maria has said, I want to share these main topics, describe the impact climate risks have on the financial sector, but particularly through the lens of national development banks. And I realize that participants on this webinar may have different varying degrees of expertise from the national development banks, or on the other side, climate risk. So we're trying to seek to get everybody on the same starting point. So let me jump into the climate change implications for the financial sector, and I think we've covered a bit of this, but let me put it in a broader sense. If I can move to the next slide about climate risks or financial risks. Really, the world is categorizing climate risks into two main types: the physical risks. So these arise from climate and weather-related extreme events, acute or long-term, progressive shifts in climate and weather patterns, which are more chronic. And of course, as mentioned, these are droughts, floods, storms, sea level rise. But then you've also got transition risks. These are associated with the uncertain financial impact stemming from the structural changes of shifting to a low carbon economy. So policy changes such as carbon pricing or taxes, technology disruption, market fluctuations, et cetera. And financial institutions are exposed to these physical or transition risks, but also opportunities through their lending activities or their own operations. So I think the key point here is underscoring that climate risk exacerbates these existing financial risk categories that a financial institution faces: credit risk, market risk, operational risk, reputational risk, strategic risk, legal risk. And these are through both direct or indirect transmission channels. So just briefly, an example of how climate-related risks directly affects a financial institution's financial risk. Simply flooding can cause physical damage to assets of a financial institution, which in turn affects its balance sheet and expenditures and becomes an operational risk. An example of how a climate-related risk indirectly would impact a financial institution's financial risk is, let's say, the implementation of a carbon policy increases the cost to a institution's client and the macroeconomic environment. This in turn would cause the risk of default with a client to increase because it's its client's business that's been impacted. So all this to say that the climate change factors require financial institutions to reevaluate their risk concepts and risk management frameworks. So moving then to what does this mean for national development banks? This is the core intention, as noted, behind developing this guidebook, building the awareness and clearly showing the link to how climate risk can impact national development banks and the role NDBs can play in leading the way. The fact that national development banks are financial institutions in themselves means they're just not immune. So I'm going to try and articulate why this is of utmost importance to national development banks to act on climate risk and what particular aspects of a national development bank differentiates it from other financial institutions. And I won't go into this in too much detail because I think Stephanie did a fantastic job, and Maria commented on these points regarding particularly mandate and structural characteristics. But maybe I could speak more specifically to this last point about the role in the transition to the low carbon and climate resilient economy. So moving to that slide in the interest of time, the role in this transition to the low carbon economy, an NDB that understands and identifies the impact of climate risk on its loan book, its client base, and the projects in its portfolio is better able to capture the resulting opportunities and strengthen its resilience to climate change. So if an NDB strengthens its organization's resilience to and management of climate risk, it should enhance their access to funding sources by becoming more attractive. So we've got, we've mentioned KfW and AFD and other international lenders. Knowing that you have a national development bank that's strongly paying attention to these climate risks makes it a more attractive intermediation vehicle. So seeking better information on how the financial institutions are planning for these risks really makes a more comforting investment decision. National development banks within their own country championing the promotion of climate risk assessments in local financial institutions. As we know, many national development banks work very closely with the local financial institutions. They partner with them. Many are lending directly to the local FIs. And so the transfer of knowledge to the local financial institutions, encouraging this adoption of climate risk management practices is critical. So let me talk then about the roadmap, which is the most important part of the guidebook. And it's a roadmap to really look at integrating these climate-related risks and opportunities into the National Development Bank decision-making. The roadmap is structured along 4 pillars of the TCFD recommendations: governance, strategy, risk management, and metrics and targets. And we've identified a set of actions each NDB chooses, and it depends on its, I guess, relative level of maturity or how far it is along the spectrum of embracing these issues. And of course, the nature, scale, and complexity of its business operations and the context in which it's operating. So let me talk first about governance. Of course, governance underpins all areas of the National Development Bank and certainly these 4 pillars. And so it goes without saying, but I think it's worth noting that the need to secure board commitment right at the top level of the National Development Bank, and then creating a cross-functional working group of credit, risk, legal, finance, strategy, with a very clear terms of reference for this working group to keep update on developments in this area. Having a climate change policy to codify the commitment and outline how it will achieve its goals, reporting to the board, capacity and resource needs, and really building these internal capacities along with setting climate KPIs. There's a small case study in the report that we would discuss. Next slide on BNDES, the Brazilian National Development Bank, thinking about climate risks and opportunities through from the board all down to the staff, and this initiative financed by GIZ, implemented by GIZ, I should say, the IPAC2, where BNDES has really worked to build capacity internally. And that's also feeding into the BNDES strategy, which is the next pillar of the guidebook or the TCFD pillars. So developing a climate risk strategy on the next slide must include not only the risks associated with climate change facing the NDBs, but also the opportunities. new product offerings, or the decision to further penetrate some climate relevant market or sector. And really should explicitly identify what are the adverse consequences of climate change on the NDB's strategic positioning. Looking at timeframes and really building this into the strategic planning of the organization. Help of climate risk assessment tools. Maria was talking about the need to develop these further, but stress testing, scenario analysis, imagining what if there was a massive flood, how would that affect our portfolio, for example. And then developing a strategic action plan on climate risk. And of course, communication, as we know under the Task Force on Climate-Related Financial Disclosures, is a critical pillar. And so the dissemination and sharing of climate risks and opportunities and its impact on the organization is critical, and that's good industry practice. So the third pillar is risk management, where climate risk is cutting across the whole organization. As I noted, it hits all aspects of the organization risk taxonomy. And so needing to integrate this climate risk as part of the overall risk management framework with a view to managing, monitoring, and mitigating these risks as any other financial risks exist. And using the risk scenario analysis to inform the strategic planning process. It's worthwhile mentioning then in the next case study, BDMG, the Subnational Development Bank of Minas Gerais in Brazil, in its upcoming initiatives, they're planning to identify, and they may have already stepped into this, but integrating climate change risk into the analysis of its credit operations and risk management using the stress testing tools to monitor its credit portfolio, identify maturity, liquidity, and risk sensitivity. So it's very much a forward-looking climate risk scenario analysis. The final pillar is metrics and targets. The TCFD recommends defining and disclosing the metrics used to assess climate risks and opportunities in line with the NDB's strategy and risk management process. So this could include metrics around physical climate risk vulnerability scores, relative portfolio exposures in high transition risk industries such as fossil fuels, and metrics perhaps around average portfolio carbon intensity. So the other aspect is around the metrics and targets is really the engagement of on climate risk with local FIs, and that's a unique sort of role that a national development bank can play. Talking about the last case study, just to mention, and a shout out to the president of ALIDE's organization COFIDE, which is Mr. Linares is leading. He's developed a eco committee within COFIDE, that's Peru's National Development Bank, covering the marketing, finance, IT, operations, and business divisions, to really track its as a starting point the carbon footprint of the organization and to offset. And this is an important step forward. And the next step for the eco committee is to develop a eco efficiency plan and to begin to build awareness around climate risks with COFIDE's financial partners. And so this is a very good example of that knowledge transfer to local FIs. So let me move to draw this to an end and really state that the key takeaway here in the guidebook is that climate change poses a significant risk, but also can be a real opportunity for NDBs to play that key role that they were designed to create, that Stephanie described so well, to lead the way in this area. And of course, actions, as was mentioned earlier, actions on climate change today will in fact determine the scope and magnitude of the risk tomorrow. In the guidebook, we use forward-looking language, such as climate risk could or would contribute, but the dynamic is that it's happening here and now. And as with the pandemic, industries and all businesses need to change and pivot and adapt their strategies to survive. So we really encourage NDBs to proactively take your first steps. And I think that's really important, that this is a first step. You can't do it all at once, but start with a policy or a core working group that starts talking about it. So thank you, everybody. Rodrigo, I'll pass it back to you.
Thank you, Diana. Diana has been working with multilateral, bilateral, and national development banks, agencies, institutions, and governments around the world in some 70 countries. And we really appreciate this partnership with her and the International Financial Consulting on this handbook project in particular. For participants' information, we are copying the download link of the guidebook in the chat placed at the right of your screen. The guidebook is available at the website of the Green Finance Lag, where other information regarding this event is also available. Now let's jump quickly to the next session, which will provide discussion on how climate risk agenda for NDB is relevant to support governments with the mobilization of national and international resources, as significant financing is required to address the socioeconomic implications of COVID-19 pandemic and climate change. To coordinate this roundtable, I introduce Dr. Barbara Buckner. Dr. Barbara is Global Managing Director of Climate Policy Initiative and Executive Director of the Climate Finance Program. Named one of the 20 most influential women in climate change, Barbara advises leaders on climate, energy, and land use investments around the world. Dr. Barbara, thank you for accepting our invitation and be very welcome.
Thank you so much, Rodrigo. Good afternoon, good morning to everyone, and thanks so much to the organizers for inviting me here to be with you today and to moderate this very important session at this exciting launch event of the guidebook. Just by way of introduction, my organization, CPIs, we are experts in climate finance and in policy. So what we do is we help governments, financial institutions, and businesses to drive economic growth while addressing climate change. And we are best known for our work in tracking sustainable investment trends, as Rodrigo just said, but also in identifying innovative business models and supporting the policy and finance solutions that help scale the transition to an inclusive, sustainable net zero economy. And we're doing this work since many years and in a very good partnership with many who are on this event today. And obviously IDB has been a very, very strong and very good partner since many years. As Rodrigo said, at CPI, we have been tracking investments into climate action since a long time, since 2011. Our latest global landscape of climate finance report found that annual tracked global climate finance crossed for the first time the $500 billion mark. And this is good news, reflecting steady increases in financing across nearly all types of investors. However, we all know that we are still falling far short of what is needed to achieve global climate and sustainable development goals. And the COVID-19 crisis renders this situation even more difficult, reinforcing the need to mobilize private commercial capital for sustainable development outcomes. Latin America and the Caribbean in particular is expected to be one of the regions most severely impacted by climate change, but the region is also crucial because of its size and resources to the global effort to address climate change and to enable a net zero world. In fact, of the roughly $580 billion that we tracked in our landscape, about 37 billion or 6% reached Latin America and the Caribbean. That's perhaps on par with the region's overall percent of global GDP, but it's not representative of the need for a region that is 40% of the world's biodiversity, as Maria said before, 50% of our tropical forests, and is crucial to and global food supply chains. Our work also highlights since the beginning of our climate finance tracking that national, bilateral, and multilateral development finance institutions are the key actors to raise, manage, and distribute finance, accounting for more than 80% of total public finance, over $200 billion actually. And within the DFIs, national development finance institutions remain the largest providers of climate finance, but institutions from emerging economies and developing countries are still not fully utilized and empowered to bridge the investment gap and address the risks that my previous panelists have so wonderfully highlighted. So what we need is a system-wide structural change and immediate action to reach this change. So to be effective, our action must not only be urgent, but also ambitious, innovative, and collaboratively. But luckily, this is not just a problem, it's also a tremendous opportunity. And just citing another IDB publication, if we invest now in the transition to more sustainable practices, over the next decade, a net 50 million jobs would be created across renewable energy, sustainable agriculture, and other green sectors. And again, Maria before has shared many more opportunities. So I'm also bullish about the opportunities, but I am concerned about the speed, which is why we're here today to brainstorm with this wonderful panel that we're going to get started now, because we do need to redouble efforts toward laying a path for a more sustainable, inclusive, resilient LAC region. And for this to happen, we really need to use public and development finance wisely to unlock private capital and increase impact. So DFIs, development finance institutions, have a major role to play. Expanding their role in a post-COVID green recovery is likely one of the cheapest and lowest risk ways to finance climate action, building amongst others on their experience with innovative financial instruments. Again, what Maria has referred to them before, and then I had shown some of the specific case studies of the guidebook as well, but also going further, looking at the country-led policy dialogues in collaboration with a private sector, and again, hopefully with the help of the guidebook, we can even go further below what needs to be happening in the future. So with this, I'm very much look forward to learning concrete ways of further empowering NDBs. And for that, let me first introduce my distinguished panelists before getting us started on our first round of questions. So it's my real pleasure to first welcome Mr. Haye Schutte, who is the Senior Counselor and Head of Financing for Sustainable Development Division of the OECD Development Cooperation Directorate, where he oversees important work to support an integrated and holistic view of all development finance flows required for reaching global development goals. Obviously, the OECD DAC has been instrumental and a very good partner also in really highlighting the importance of national development banks. So Haye, it's a real pleasure of having you here today. Let me also introduce Ms. Camille Laurent-Villain, who works in the department dedicated to strategy and institutional relations of the French development agencies, Agence Française de Développement, with a focus on climate risks, and she's monitoring the European taxonomy of sustainable financing, alignment with the Paris Agreement and the just transition. Again, we heard also from before already the importance of metrics and of data there. And a warm welcome also to Mr. Johannes Scholl, who is the Head of Division Energy and Financial Sector in the Latin America and Caribbean Department at KfW, which is the executing agency of the official bilateral German financial cooperation, where he oversees a portfolio of over 3 billion euros of climate-related investments in Latin America, most of it with the regional and national development banks from the region. And then last, but certainly not least, it's my true pleasure to welcome Mr. Juan Antonio Quetara, who is the Chief of the Connectivity, Markets and Finance Division of the Inter-American Development Bank. This division engineers funding mechanisms and risk mitigation structures to support public investments in public-private partnerships in capital market development, digital connectivity, and green financing. So as you can see here, we have a very strong panel with lots of expertise that certainly can highlight how can we really empower NDBs more and what needs to happen in order to scale invest. Right into the discussion, and let me pose the first question to our panel here. Again, we all know that NDBs can pursue climate-related investment opportunities and take a relevant role in supporting the implementation of their government's plans for climate-resilient transitions, as well as in contributing to a sustainable recovery as countries progress from the social economic effects of the COVID-19 pandemic. So I'd love to hear from each of our panelists what, in your view, are possible partnerships that really foster capital mobilization and the de-risking mechanisms to NDBs towards sustainable finance, making sure that we maximize resources for development and mitigate both economic and financial risks. And with that, let me start the round by calling first just see Haya, if you're here.
Thank you, Barbara.
Okay.
Yeah, thank you, Barbara, for the introduction, and thanks to the IDB for inviting the OECD to say a few words. I think, Barbara, frankly, Stephanie, Maria, Diana, yourself, I think have laid out the case for national development banks and also regional development banks in helping countries to transition towards a low emission climate resilient pathway excellently. As you have alluded to, Barbara, we have been working for quite a while at the OECD in support of the Development Assistance Committee about the critical role that public development banks are playing and should be playing in order to support countries. By the way, very, very closely also with the IDB. And in doing so, talking about partnerships, what we see is obviously the need for public development banks to shift from a role of financiers and mobilizing or facilitator of private finance, and we see already a movement here, but also an additional role in becoming an indirect mobilizer of private finance. And here you could say that there are at least three additional roles, as first as an intermediary of international climate and public development finance, for example, through blended finance approaches. Secondly, as an influencer of policies that can help then shape policy frameworks to encourage and channel private investments. And then also critically, as the examples by Maria, among others, have showed, also as a pipeline developer that then can identify and develop bankable projects. Now, Maria gave and Diana gave a couple of examples from Latin America. We just published a paper that looks into the special cases of BNDES, Brazil, but also of the Development Bank of Southern Africa, so South Africa. So let me therefore maybe switch to Southern Africa and just give a quick illustrative example of a climate finance facility that the DBSA has set up. Basically a structured fund with loan capital being provided by the DBS, and then also loan capital coming from the Green Climate Fund. And this joining of forces allowed basically then for credit enhancement funding for local commercial banks. And the big issue here was that through this kind of partnerships, it allowed also the commercial banks mobilizing private capital, obviously, to basically extend that tenor beyond the normal regulatorily given maximum of 7 years. I just mentioned this as an illustration, the DBS, and you will, for those that have a look into our publication, will see that the DBSA not only then obviously partnered up with an international financier and with local commercial banks, obviously also partnering closely up with both the national government as a shareholder, but also local governments. And it was also very much on the ground, decentralizing some of its capacities in order to basically help to identify appropriate projects. So, Barbara, in a short, I think what we're seeing from the practice, and I think what we also see as a necessity, is a multifaceted partnership of development banks, both with the private sector, with government, with local other financial institutions, and then obviously also critically with local authorities. With that, back to you, Barbara.
Fantastic. Thanks so much, Hai. I think very nicely highlighting already with a specific example actually how such a partnership could look like, and look forward to hearing more from other panelists. So let me maybe just move on directly and invite Camille to share your thoughts on really this question of possible partnerships.
Thank you very much, Barbara. Let me first start by warmly thanking IDB and LED for hosting this conversation today. As already mentioned by some of you, public development banks, and more specifically national development banks, build bridges between governments and the private sector, between domestic and international agendas, and between short-term and longer-term priorities. They represent visible hands to help mobilize and direct public and private financial flows towards building back better and sustainable development investments by providing long-term concessional resources, de-risking instruments, by implementing technical assistance programs, and by providing policy advisory services, and of course, by building partnerships. More specifically, regarding these partnership issues, at IFD, we are involved in two different kinds of partnerships. First, we worked, of course, as a development bank with local, national or regional banks to provide long-term financial and technical support. And for this, we adapt our financial instruments to our client needs. We can combine our resources with external resources, and those partnerships aim at developing a pipeline of projects on climate finance adaptation or mitigation. They aim at working with banks to help them better integrate ESG and climate-related risks into their practices, and they aim at defining internal strategies aligned with the SDG and climate agendas. We are also very active in engaging with a network of development banks. As you know, our CEO chairs the IDFC, the International Development Finance Club, that organized with the World Federation of DFIs in November, the first edition of the Finance in Common Summit. And that was a summit that gathered for the first time all PDBs of the world, as well as their stakeholders, to tap the full potential of public development bank system to help reorient financial flows towards SDG and climate agendas. To be maybe more precise on the topic of climate-related risks and opportunities, our opinion is that DFIs and national development banks have a specific role to play. First, of course, by financing investments that are consistent with low carbon and resilient national or local policies. And second, by working to better understand who we finance rather than solely focusing on what we finance. This means making more in-depth quantitative and qualitative analysis of our counterparts' portfolios and exposure to fossil fuels, their greenhouse gas intensity relative to a scenario, their positive contribution to the climate agenda, the context of their activities, of course, and their regulatory framework. So we believe that it will all help us to better understand how we are exposed to climate-related risks, not only at the project level, but also at the client level, and to try to help those clients that can be exposed to make their transition towards low carbon and resilient pathways. And we think that this subject is really of interest for the development of a new partnership between all actors, because there is a real need to share knowledge, experience, and best practices. And maybe one word on climate risks. At IFD, we've been working on that topic for a few years now, and we have established a roadmap, considering that we are exposed, of course, as a bank through our client portfolio. But that we have also a role to play as a development agency to help our clients to better identify those risks and to accompany them through financing and technical assistance programs in their transition pathways. So we have this roadmap with 4 pillars. The first one is to understand and to assess IFD's exposure to climate financial risks, both physical and transition risks. We have a second pillar that is to integrate climate risk in our public policy dialogue with the countries we work with, and we have worked with CPI and in South Africa to identify how public entities are exposed to transition risks, and we are starting the same exercise with Colombia right now. The third pillar of the roadmap is to contribute to the uptake of climate risk analysis tools by IFD's financial partners, financial institutions, but also regulators and central banks. And we have a fourth pillar, which is about how we can contribute to the discussions and the designing of tools, norms, standards on climate risks. Thank you very much.
Fantastic. Thank you so much, Camila. Thank you. Summit, which I think is like the example of real kind of partnerships and how you get at the banks, and I think has certainly started a lot of very important additional initiatives. So I think certainly look forward to that. But also I think your point on making sure that you don't only look at how you finance and what you finance, but really who you finance. So really having a closer look at the counterparts, I think, is something which certainly needs to be much better integrated also in this thinking around the partnership. So thanks so much for your thoughts. But with that, let me hand over to Johannes. Looking forward to your reflections on this question.
Yeah, thank you very much, Barbara, for the introduction, and also thank you to the IDB for inviting me, making this very interesting and exciting session possible. I think I want to make 2 points here on partnerships, and one is on partnerships where I think partnerships that enable development banks themselves to do more and better climate financing, and another focus on what types of partnerships are actually needed for developing that role that Haye referred to, allow development banks to unlock third-party financing and investment, because I think they're related, but somewhat they are also different. And I think the first one is actually the low-hanging fruit, making good use of the balance sheets of the development banks. And I have the feeling that I'm talking so much about innovation lately that I feel that sometimes we tend to forget that actually we have one of the most successful financing instruments with a long-term track record right before our eyes. That's the development banks themselves, the way they do business for the past 60, 70 years. Decades of experiences and tested and proven. And I think there are a couple of interesting lessons learned from how the development banks also reacted to the COVID crisis that Stephanie referred to in her presentation that I just would like to share with you from Germany. The example, our annual balance sheet from KfW in 2020 went up from 77 billion euro per year, the lending volume in 2019 to 135 billion in 2020. That's an increase of almost 60 billion, 95 increase of lending. Historically, that's the largest increase we have ever experienced as an institution in our history. So it was, of course, because we executed a big part of the German Corona emergency program. But it required a couple of partnerships to make that happen. And I think the first one, and that's something because it happens behind closed doors, but it's very important to keep that in mind, is the partnership with our owners, with our shareholders, because that's actually, I recall from your presentation yesterday in another panel I participated, Barbara, where you said policy first, yeah? And I think that's the key. I mean, there is a political decision at the beginning that says, guys, I want my development bank to be a transformative bank. I want my development bank to do this, to become the financial agent of change towards low carbon development pathway. That's at the beginning. And that's what the German government also decided related to COVID. KfW, we want you to take care of this. And the second thing, the second partnership that was equally important, and I think even more important, was also a partnership with our government, but in a different role. And the role as a guarantor, because we are a regulated bank. We cannot just accommodate 60 billion additional euro transactions in high risk or even very high risk investments. There is no room for on our balance. We can't just do this. Yeah, And no bank in the world can do this without jeopardizing its own solvency and its own capacity of lending. So what the German government did is that they provided a risk coverage of 80 to 90, even in some cases 100% backup guarantees to us, so that we were able to actually deploy the funding. Yeah, and I know that in several cases it worked differently in Latin America, but many of our peers, development banks, COFIDE, for example, in Peru, had similar setups with their own governments to deploy actually the COVID emergency programs. And the third thing I think that was important was the partnership with the financial intermediaries, those who actually channel the money to the clients. As a development bank, usually, that's also different in many cases. I mean, not all development banks are equal, but usually you deploy your funding through financial intermediaries. So you need to develop the programs. They know the market, they know the clients, they have their systems. You need to find procedures and ways to collaborate to deploy the funding at scale and quickly. And digitalization is also very important here. I mean, you just don't have the staff to do like, you need to find ways of standardization to deploy stuff at scale. So transferring this idea also to the climate change agenda, I mean, yes, I mean, to a government or to a shareholder to determine my development bank needs to be a climate bank, maybe introducing a climate quota or raising the climate quota of the bank is a possibility. And as a guarantor, providing guarantees to make actually to enable the bank to go into the risky business. And maybe the second quick thought is about innovation, because I think that homework is one thing that we have to do inside the banks with our shareholders, with the governments and the guarantors and the financial intermediaries. But then if we are talking about innovation, becoming enabler, doing things differently, maybe trying to, well, mobilize investment or even complete sectors to take off, I think that requires partnerships on different levels and in different dimensions. And I think there is one personal dimension and one institutional dimension. So of course, you need the right institutions around the table. So if you want to structure a new financing vehicle, an investment fund, with a first class piece from the German government or the European Union, like we, for example, pioneered now for the Latin American Green Bond Fund, the fund, an investment fund in green bonds in Latin America that's going to be launched by the end of the year. Of course, you need the governments on board again, those who are capable of providing to take the risk. You need private investors on board, and you need to structure the fund in a way that a private investor is willing to put its money in there. And you need to work with private service providers who actually have the agility and the knowledge of the market to deploy the fund. In our case, it's Finance in Motion and Santander Asset Management, for example. So this is a very exciting initiative. It just started. And there is, apart from that institutional dimension, I think there's also the personal dimension. Because you also need people who have the right background and people who have ideas, people who are creative. And sometimes you find them in your institutions, but sometimes you don't. So then it sometimes makes sense to bring on board consultants, think tanks, or technical cooperation agencies like GIZ that was mentioned, for example, who maybe have the right background and the right ideas, the right instruments to help you develop what you want to develop. I can make a point here. And back to you, Barbara.
Fantastic. Thank you so much, Jonas. I think that was very, very helpful, and I think I very much like the way that you kind of distinguish between the traditional thinking, the internal thinking, and then really the innovative thinking. I think we got to become, and I said that yesterday as well, we got to become more granular in how we think about these issues. So I think you kind of very nicely broke that down and really thought about like what are the different levels and the different types of partnerships we need, and again, going a level below what we usually say. So thanks so much for sharing that. And you did mention also digitalization, which actually is a very nice segue into our next speaker. So Juan, I'm excited to hear your thoughts on this question around partnerships. The floor is yours.
Yes, thank you, Barbara. Good morning to you all, and good afternoon to those who are in a different time zone, for being with us, because I think that this is a very important topic that we are talking here. And I think that we're advancing, and we're in a critical situation in terms of having to make decisions that will have strategic consequences in the future. For us, the situation, so that you have a little bit of an idea of what partnerships mean for us. Before the crisis, even then, in the earliest 1910s, let's say, or the region of Latin America had a deficit of between $300 and $400 billion per year of investment in regular infrastructure, just to keep up with the developments in the world and to keep up with competitive pressure. They had to increase in an overall of 400 billion per year in infrastructure. On top of that came the problem of facing the digitalization, the digital crisis that also is part of the problem in Latin America, which amounts to another 10 or 20 billion a year of investments in infrastructure. And on top of that, we have the investments required for mitigation and accommodation. So the bill is huge that we have to pay the countries in the region, in Latin America and the Caribbean. And neither the governments, nor investment banks, nor donors in general have enough money to pay, to foot this bill, this huge bill. Now, if we want to be able to do something about it, the only way in which we can do it is to bring capital from a source which is not neither public nor from development banks, and that source is the private sector. I think that what I'm saying is obvious to everybody here, but I think that the numbers, maybe you didn't have the magnitude, the size of the numbers in your heads. So these are huge numbers. So then we have to ask ourselves why it is that the private sector doesn't come in the first place, why it is that these unfunded needs are still there. And the reason is obvious to everybody again, is because a question of risk. The risk is too much. And when I say risk, I mean the relationship between risk and return. So they are facing much better prospects in other places, in other investments than in the region and in the particular domain of the green or the climate investment. So if we want to do something about it, what we have to do is to create incentives for this capital to change the way in which they view things. So in a sense, we have to distort or to move or to shift the risk return frontier of the investments that we as policymakers or as helpers of policymakers, we want to accomplish. And that's not easy. I mean, this is easy to say, talking at this level of generality, we can say as much as we want. The problem is when you come down to implementation. Okay? The implementation is very complicated because there are many different ways in which you can do it. And it's not only complicated, but also it can be difficult, easy to lose track of what it is that you are doing. By that I mean, for example, when you are in a situation in which you are offering implicit subsidies to the private sector, but letting them to co-finance an investment in a project, and you are bringing implicit subsidies in your rates, the question that we have to ask ourselves is, how much of a subsidy should I bring to make sure that I am optimizing the public money that is implicit in the subsidies? this is something that very seldom people ask themselves. They typically, go about bilateral, many times it's a bilateral negotiation between the firm, the fund, the bank, whomever it is that is investing from the private sector, and the public entity who is administering the public money with implicit subsidy. So that creates a situation in which sometimes it's very asymmetrical because the private sector has the upper hand because of their knowledge, their better information, and a pile of questions. So that brings us to the one conclusion that if you want to deal with this type of situations, you have to deal from the point of view of a financial institution. So development banks, and I stress the word banks, is key to be able to administer this public money in an optimized way, let's put it this way. And that is something that is very present in our strategy when we are rolling out our operations in the region, to be able to make sure that we can say, or at least that we can have a sense that we, with our partners, are optimizing the use of public funds. And that is something that I think that everybody should have, present as one of the preconditions at the time in which partnerships are sought or are established or are formalized. So I think that this is something that worries us a lot, and that's why we are trying to develop an instrument, a methodology, I would say, to be able to accomplish that. And that is the idea of partnerships, platforms for different areas and for different sub-regions of the region, even if you want at the level of the countries. Because that is a place in which you can have concurring interest, and it's much easier to make, at least to have a sense that you are really using the minimal amount of subsidy that it is required for the particular investment. And just to finish, when I say subsidy, I don't mean just subsidy in terms of cash outlay or blended and the interest rate, but when I say subsidy, I say also the assumption of the risk, which is a little bit more difficult to measure than just the blend on the interest rates. So I leave it here for the next round of conversation. Thanks.
Thanks so much, Juan. And I think, yeah, again, like just really insisting on this importance of again optimizing the use of public funds. But I think, as you said, I think it is again a next level of granular level. It is about how can you make sure that the institutions take the risk that they are most appropriate to take. And I think this is like something through these platforms, these partnership platforms that you mentioned, I think is certainly something that you can be doing. And I'd love to just go actually continue right with you, Juan, and just go on our second round of questions and really dive a little bit deeper to understand some of the main policy drivers that you think are at the national level that could support somehow the national development banks within their mandate and really make sure that the sustainable finance is well targeted. So just, going back a little bit what Johanna says before, again, policy leads the way. So what is it that you think could be really helpful? And as we are a little bit running out of time, I would like to ask everyone if we can maybe kind of do like a 3 minutes kind of a second round of replies. I'd appreciate that. So Juan, back to you.
All right, so I'll be quick. Basically, at the national level, for allowing domestic national banks to develop their tasks, I think that there are basically 3 things that we have to consider. One is the level of commitment of a government with that particular instrument, that is the National Development Bank. That is key, that Johannes, my friend Johannes just mentioned it before. This is one of the major innovations that seems to, to work, right? So that's the first thing. Second thing would be the regulatory framework. It is very important that regulators are, sensitive to this part of the implementation of public policies. And there are many things that regulators can do to foster climate investments, the same way in which many years ago they did it, for example, to foster house financing. Okay? So that's the second thing. And the third thing is our work, in a sense, of the regional multilateral, because we can bring a level of coordination that make, think countries that they're not alone on their task and they can learn from each other. And that is something that we are doing, using and partnering very closely with ALIDE, which is one of our major partners in this endeavor. Okay? So I leave it here. Thanks.
Fantastic, Juan. Thank you so much. Very clear. And I think certainly something I expect also to hear from some of the other panelists. But let me straight hand back to Johannes. Back to you.
Thanks, Barbara. And Juan almost took my intervention already out of my mouth. I also have 3 points. They are almost the same as Juan, but we didn't agree before what we wanted to say. So I think the first thing that Juan mentioned is also something that I noted down on the level of the shareholder of the National Development Bank, the policy that a government provides at the level of a shareholder owner of the make climate change a priority and make it measurable with targets. Be monitoring system, ESG, risk management systems, climate quotas against which the bank is measured. And the second thing is the general framework conditions that also Juan referred to. But I think, I would maybe split the framework conditions in two. One is the general framework condition, like the business-friendly environment and the political economic stability that you need in the country, like the general environment to so that investors actually have confidence and trust to invest in the country. And you can have the best sectoral policies if you just are in the middle of a financial crisis in your country and renegotiation of your own debt or something like that. It's really difficult to mobilize investment for your climate policy, of course. So that's really important. And then there's the sectoral policies, and I think the governments and public entities play a major role here in determining the national investment plans and also the framework conditions in which, they decide whether they build a metro or whether they don't, or whether you have an energy law that provides incentives for distributed generation of energy or PPA auctions and so on. So that is all this is conducive for triggering private investment.
Fantastic, thanks so much. And yes, very aligned, but again, I think some additional nuances, which is fantastic to hear. But with that, Camille, back to you.
Thank you. Well, I would say that to tap the full potential of the National Development Bank and to help reorient all financial flows towards climate and SDG agendas, we should do maybe 3 things. Some of the other panelists already mentioned some of my points, so I would be very brief. So I would say work with governments, of course, on the purpose and the missions of NDBs to fully integrate the climate and the SDG agendas and to shift strategies to the realization of the Paris Agreement objectives and the Agenda 2030 objectives. Of course, provide national development banks with adequate instruments and financial capacities to fulfill their mission. So have sufficient equity. They should benefit from guarantees and subsidies to accompany their clients in their transition. And I would say that to have a common understanding of what is aligned and what is not with SDG and climate agendas could be really helpful too. So taxonomies, for example, at the national or the regional level, taking into account the context specificities, can be useful. And I would like to mention that within IDFC members, we have this common definition of alignments. CPI provided it, so that this framework is a comprehensive scope of action, and so we look at all the portfolio, not only at a subset of projects that have climate co-benefits. We look at long-term horizons to ensure that what we finance is compatible with longer-term climate pathways, and the ambitious scale, of course, of contribution. So we go beyond the direct financial activities, and we try to look at our clients to help them do the same. Thank you.
Thank you so much, Camille. And yes, I think taxonomy is certainly extremely important in what you can't measure, you can't manage. So I think really having the good data in place is key for all that. But with that, Haya, let me pass back to you.
I will follow the example of the other panelists and only mention 3 things. So to keep it, obviously not surprisingly, very much aligned with what colleagues already said before. Let me focus on shareholders. What we have done, we looked into the mandates of different public development banks and compared that with the share of their funding when it comes to supporting climate transition. And they are very much directly linked. So I concur with Juan and Johannes and Camille that really centrally is a decision, deliberate decision by the public owners, by the shareholders, to make their development banks, if you like, a tool and an instrument and an actor, a change leader, you could even say, in the transition. And obviously, as Johannes was alluding to, that needs then be translated into the governance, into the strategy, into the risk framework, into the operations. And I must just say that once again, kudos and congratulations to the IDB in regard to the guidebook, obviously, which so nicely takes these issues up, as Diana has been alluding to. A second point I would like to make, when we look at development banks, obviously most of them are really set up to make a good return. And that comes out of a certain transition. We all remember, or may remember, times when development banks did not make sufficient return in order to cover their costs and their risks. Now, some of development banks are quite profitable. And I believe, or we believe, that the kind of work that we are sketching here in the panel will probably need to reconsider the kind of return risk impact approaches government owners, public owners will need to ask from the development banks. Because obviously on the loan, on equity, on venture capital, others, you can and should be properly structure this in order to cover your costs and your risks. But other activities that we have alluded to, capacity building, influencing policies, building pipeline, I mean, typically these issues require some support from governments. And I think you can do it differently, but obviously banks need to be supported in that. And one way would obviously to lower return expectation and channel back into this, if you like, non-financial technical assistance, capacity building kind of activity. So my second point, my last point is just because I think Camille alluded to that, and Diana earlier, I think we think that transparency is key, taxonomies, and we believe there's still some way to go, also for national development banks, to be transparent about the investments they do, to stress the kind of additionality their investments are having, and to show the impact. And I say so in the strong interest of development banks, because I think only that they can really prove, through evidence, the additional role. They can get public support. They can win over some of skeptical public, which still are, a bit hesitant, and Juan referred to that when it comes to mobilizing private finance. But I think at the end, also their operations will be more sustainable, because it allows then other private sectors, players, to come in, because they have a better understanding of the kind of risk return impact profile the markets are having that they're currently still hesitating to come. So these are the 3 points: shareholders, return, impact, risk perceptions, and then the whole issue of transparency. Back to you, Barbara.
Thank you so much, Hayat. I think particular, I mean, I think all these reports of each and every panelist was fantastic, but I very much like the addition that you made, Hayat, on the non-financial technical assistance. I think really kind of building the capacity and making sure that, you know, all the, again, the staff in national development banks is empowered, I think is extremely important. And again, obviously, many of the banks, the DFIs are doing a very important work in this context. So thanks so much for that. I am afraid that we have come to the end of our panel, so I'm unfortunately not able to. I wanted to make a last speed question to my panelists, but I do realize that we are running late in our program. So let me just take a minute just to try to summarize some of my key takeaways from this excellent discussion here. I think really want to start again with what we've heard from the beginning, also from you, Haya, that NDBs have to shift from financiers to mobilizers. I think both internally learning the lessons from, for example, how to best use the balance sheet, as Johanna said, but also how to best use money most effectively, you know, optimizing subsidies, as Juan said, but then also beyond the traditional financing, to use innovative financial instruments to really unlock private capital. And again, I think this is something where we really can make much more progress, and we heard it also from previous panelists. For all this, as we have heard from our panelists, partnerships are key. I want to repeat what I said before. I think we got to become much more nuanced, really much more granular on how these partnerships can look like. How can we even institutionalize some of them through platforms for partnerships, but really partnerships certainly will make this happen. But in addition, there is a need for a common language. There is need for transparency, for taxonomies, and certainly for monitoring and monitoring systems to really make sure that we can show the impact and the overarching really returns and that the NDPs have, but also the impact on the ground on really climate action. As I said, I think capacity building is required for all that, but also I think the final point I just want to make, I think knowledge sharing is critical. We've heard that both from examples that we've heard on this panel, but also from previous examples. So I think, again, I very much look forward to continue this conversation here. But let me just close by saying I think we were very aligned on this panel, which is a good step forward, certainly, and certainly the guidebook will help to make sure that we can go beyond all the efforts that are going on and all the efforts by my panelists. So with that, let me thank again IDB and Alida for having us here. Let me thank my panelists for fantastic contributions, and let me hand back to Rodrigo. Thanks so much, everyone.
Thank you, Barbara, for the excellent coordination in this panel, all the panelists for this excellent debate in the roundtable. Some key action points were shared here today, very fruitful discussion indeed. Now we're taking a break, but as we are running a bit behind the agenda, it will be a short break. We'll be back in 5 minutes. Coming right up, the session, Mainstream Climate Risk Management for DFIs. Until then, let's enjoy a quick rest, maybe grab a cup of coffee. See you in 5 minutes. Thank you. Welcome back. Let's get back to business. The next session, mainstreaming climate risk management for development financial institutions. I invite my colleague at the IDB, Mr. Diego Herrera, who will coordinate the discussion. Diego is lead specialist in the connectivity markets and finance division of the Inter-American Development Bank. Its fields of action are regulation, capital markets, fintech, financial inclusion, productive financing, sustainable finance. He also leads the fintech initiative and the REDES, network of regulators towards sustainable finance in Latin America and the Caribbean. My colleague Diego, thanks for being here. The floor is yours.
Rodrigo, thank you very much. And thank you very much to our panelists. We will try to better do a discussion. And the idea of this panel is to go deep into some of the main topics that deal with mainstreaming climate risk management for development financial institutions in Latin America and the Caribbean. The dynamics for our panel are very simple. We will have just a couple of rounds of questions, and from there we will take it to a conversation type of panel. We have a very interesting panel in terms of the different points of view that they can deliver and great experts in their fields. So please, let's go and introduce each of them. And I will ask a question to each of them, and then from then I will try to move it forward with questions, more general questions for everyone. So I will begin with someone who is a friend of mine and a really close colleague. We are working with him currently in making a measurement of systemic risk for 4 of our Latin American countries for the financial systems of those countries. And we are creating a new model for measuring that systemic risk with climate risks included. So there is no better opportunity to talk about that. And I think that it's very interesting to present Professor Richard Berner. Professor Berner is a clinical professor of the management practice in the Department of Finance from NYU Stern. And together with Professor Robert Engel, the Nobel Prize from 2003, he co-directs the Stern Volatility and Risk Institute, which IDB is working with in the topic I talked to you about. So among other positions, Professor Berner served as the first director of the Office of Financial Research of the US, the OFR, from 2013 and 17. He's worked at the Treasury. He's been the chief US economist at Morgan Stanley for several years, and the co-head of global economics also at Morgan Stanley. So it's a pleasure having you here, Professor Berner. And let's start with something that is more like broad, so people get the understanding on what is it that we're going to measure when we talk about climate risk. So the question is very specific. Can you tell us about the current, let's say, state of the models to measure climate risks in the financial sector? What do we do exactly with those models? And also something that was talked about in the last panel, which is the data requirements and the objectives of the models. The idea, before Professor Berner answers our question, is to have answers of 4 minutes or less, so we can move really fast with the other panelists. So Professor Berner, welcome. Thank you very much for being here. And please tell us about climate risk models in the financial system.
Diego, thank you very much for the opportunity. I don't see myself on the screen, but I assume that I am there.
You're there, you're there.
Okay, great. I just want to make sure that everybody understands on this panel and this webinar, the challenges that we face in doing the kinds of assessments that you're talking about. But let me just quickly spell out some of them to appreciate their implications for climate risk management and modeling. First, uncertainty. These risks are unprecedented, and so the timing and size of any policy action is unclear. We do have a high degree of uncertainty that some combination of physical and transition risks will materialize. Second, past data, and you implied that you want to talk to me about data, are not a good predictor of the future, so the models that we have are less relevant. Third, there are far-reaching structural changes underway, so these things are difficult to model. The time horizon of climate risks is beyond the usual decision-making horizons. Do we take account of opportunities as well as risk? And last, in terms of measurement or disclosure, neither firms nor regulators have yet agreed on what and how they need to disclose. Now, we're making progress on all of these, and I won't cover all the things that are going on, but there are good efforts to set standards for disclosure. They are not yet broad and ubiquitous, however. There are some good modeling efforts, and I want to tell you, Diego, that I have been involved in modeling the economy and financial markets for more than 50 years. And for my profession, these efforts aren't yet adequate. Modeling the effects of climate-related risks, as you appreciate, is an order of magnitude more difficult. Now, we can't wait 50 years to develop the perfect model. We never will. So I applaud the efforts to accelerate the developments of models that are good, if not perfect. The integrated assessment models, as they're called, that are used today do have many benefits. They give an internally consistent science-based framework to help us evaluate the feasibility of different climate and/or sustainable development goals. And we can look at the interplay among those things using these models. And they yield a key indicator of the level of transition risk, namely the shadow emissions price. Now, that's a proxy for government policy intensity and changes in technology and consumer preferences. And that's very important for mobilizing capital, financial risk assessment, risk transfer, and insurance, all of which the previous panels have alluded to. But the challenges that I mentioned mean that the output of these models is subject to a lot of uncertainty. So we use these models to help with scenario analysis. That's the focus of the Network for the Greening of the Financial System. Scenario analysis gives us a flexible what-if methodological framework to explore the risks that could appear in different possible future states. The latest 6 NGFS scenarios published earlier this month offer detail that will enable us to improve both measurement and analytics. And the French climate pilot exercise is a good example of the use of such models and scenarios. Now, these aren't the only models that we should explore. As you mentioned at the Volatility and Risk Institute, we've developed a framework using market data for assessing the capital shortfall that banks might experience because of a climate shock. We're currently exploring the application of this framework to banking systems in 4 Latin American countries, as you mentioned. As with our work on S-Risk, a similar tool to assess the impact of financial shocks on banks, we think that this tool will complement other ways of assessing risk scenarios and ultimately stress testing. And we are working on extending the framework to assessing portfolio risks for lenders, investors, and asset managers. And our work so far shows a substantial stock market response of bank stock prices to returns in a so-called stranded asset portfolio, especially in Europe and especially recently. And this suggests both the validity of the concern about more than the immediate risks and the need for future research. So let me wrap up by saying and emphasizing the need for consistent, comparable risk disclosures. Scenario analysis will help us meet these needs by better understanding what they should look like. Disclosures and analytics are parallel efforts, and let's keep working on both.
Thank you very much, Professor. I agree to that point in terms of the disclosure. And there are many, let's say, offers in the market currently for such disclosure, and the market is urging for standards, which actually leads me to our next guest, who is Renko Fischer. Renko joined the finance initiative of UN Environment program in 2007. He's responsible for the initiative's strategy on climate change. He develops and implements projects that support the alignment of the finance sector with climate compatible economic development. He has also worked at the German Development Finance Institution, the DEG of the KfW group of banks, and helped design structured deals in project finance in Europe with base in Germany. So Remco, welcome. We're very glad to have you here. And my question relates to what you actually do in UNEP-FI. It has been, actually your UNEP-FI has been leading the discussion on climate change. And I would say this before the topic was mainstream in the financial industry. You have developed several tools and guidelines to align the financial sector with climate compatible developments. The latter is a crucial piece of work for DFIs. Given that this is a specific subsector of financial institutions, the DFIs, how can them align to the guidelines proposed by UNEP-FI? Which are the assumptions for such alignment? Thank you very much, Remco. The floor is yours.
Thank you, Diego, and thank you to the IDB and colleagues for having me. I think, for me to be able to answer to your question, I think I need to just, take a step back and look at the wider context, that we're operating in at the interface of climate change, the economy, by extension, the finance sector, and then yet by another extension, the providers of public finance, because I think we're discussing, of course, the focus today in this panel, but also in the full conference is risk, climate risk management thereof, etc. But what we've been really focusing on are additional dimensions, beyond risk, and I just want to speak a little bit about that, and also what this means really for development financial institutions. Where I work, UNEP Finance Initiative, it's a network of financial institutions run by UNEP, the United Nations Environment Program. But those financial institutions are largely commercial. They're market actors providing commercial private finance, you could say, for lack of a better term. We do have a number of also DFIs and MTBs in the membership, but they're almost there as observers. The main thrust, the main topic is the financial market. So at the intersection that I mentioned, climate, economy, finance, development finance, of course, one thing is risks and opportunities. And one of the things, and those risks and opportunities need to be identified, assessed, managed, mitigated over time. If there are opportunities, they need to be seized. And that's one of the things that financial institutions need to be on top of. And I think the better institutions, and it's challenging, as other panelists have mentioned, it's a new topic. All of this needs to be done through scenarios, forward-looking scenario analysis, new modeling approaches need to be developed, and all of that is not trivial. But of course, institutions are doing this, they're getting better on it, and as they get better on it, they will become climate savvy, more resilient to the risks that climate change throws at these institutions. And by extension, their portfolios will become more resilient to those risks, including the companies and the projects on those portfolios. And at the end of the day, this will, of course, then help ensure financial stability at the systemic level. And this is what, really the TCFD that now has been the Task Force for Climate-Related Disclosures that we're discussing in part today is all about, is ensuring financial stability in light of climate change. And we as UNEP-FI have been doing a lot of work since 2017 in helping our members and the financial markets and the finance sector adopt these TCFD recommendations, adopt scenario-based risk analysis, both when it comes to the physical impacts of climate change as well as to the low carbon economic transition. And now, of course, it's just commendable that the DFI community, the MTB, the public finance community is also kind of moving in lockstep with the private sector on this, or perhaps even leading the private sector on this as it should be. My main point is, though, that all of this risk focus is not where the story ends. I think it's really where the story begins in terms of the finance sector and climate change. And this is where we come in as UNEP, because our mandate as UNEP is not so much to help create a finance sector that's resilient in light of climate change. Our mandate is to help green the finance sector so that it can use the tools that it has to green the real economy. And the thing is, you can be a company or a financial institution, a bank, a development bank that is superb at climate-related risk management, excels at it, but that doesn't mean that that company is becoming greener necessarily, or that that company is becoming, to use another term, aligned or not with either the Paris Agreement or the SDGs. So where we're coming from is we need to add a new dimension to the risk and opportunity story, and that is one of impact and alignment. Risk and opportunity is an outside-in story. How is a changing world affecting my organization, my portfolio? And it's very important. I don't want to take any importance away from it. The additional dimension now is impact alignment. It's an inside-out story. How's my organization, my portfolio affecting the world? And I'm conscious this is a new expectation. It's a new expectation, certainly for commercial financial institutions in the market. Why should they be aligning with these UN frameworks and managing their inside-out impacts? But it is gaining traction through things like, currently the net zero agenda, where we have, all companies around the world, many companies around the world, financial institutions around the world, 160, I think it is at the moment, private sector financial institutions setting net zero targets for their portfolios. So I think that's one important dimension. And this is really, you asked me what's really our work, what's it focused on? It's also to do risk and opportunity, but in addition, add impact alignment to the mix. In terms of the assumptions that then go into the scenarios, or which scenarios then become relevant to financial institutions, including DFIs or national development financial institutions, I mean, all financial institutions, it really depends. If you need what's the finality, the objective? Is it to, if the finality is to align your portfolio with, say, the Paris Agreement, so with a 1.5 degrees outcome or net zero economy, then you will choose the scenarios that do that. And the IPCC provides those scenarios, right? They're all out there. You can choose those, and that becomes the scenario that you use to guide your portfolio with, the assumptions in it. If your finality and objective is to manage risk, then of course you need to look at a much wider set of scenarios across temperature outcomes, identify which temperature outcome do you think is the likeliest, and then identify and assess the risks that come with that scenario. And and I think that's, that's the same challenge to all financial institutions, whether they're a commercial financial institution or more of a public financial institution. So yeah, I think it's work that applies to all, but the assumptions and the choice of scenarios really need to be guided and driven by the ultimate finality. Is it risk assessments and risk mitigation, or is it, a more policy-oriented portfolio alignment objective, so in other words, environmental target setting?
Yeah, and that balance is hard to achieve for policymakers, and the supranationals are, let's say, struggling a little bit with what is the next step to be taken. And I agree with you to that point. So to that extent, I think that this ties perfectly with our next guest, Mr. Alan Gomez. Alan is the Latin American representative in this particular panel. And he's the member of the FSB TCFD group and the chair of sustainability at the Mexican Banking Association. He's the current vice president of sustainability at Citibank Mexico. He has an extensive career working as an engineer in topics related to sustainability, and he's one of the leaders of sustainability in the financial sector in the region. And it's very, very important to have you here, Alan. So Alan, this ties to the comments from Renko. The TCFD recommendations that Renko mentioned are the standard for climate-related financial disclosures. They are part of the inputs that the supranationals, such as the Basel Committee and IOSCO, are using for future regulatory actions. And some regulators in the region are also using these guidelines for their own purposes. What is the status of those recommendations in Latin America and the Caribbean? And do you think, to that extent, that there are more actions needed to be taken on the side of the financial institutions of our region?
Thank you, Diego, and thank you, the IDB, also for the invitation, as well as it is an honor for me to be being here with my colleagues from other institutions like Juniper 5 and NYU Stern, etc. So what can I tell you? Well, yeah, I think first of all, let's take into account that TCFD recommendations are now ranging from beyond 2,000 organizations that support them. And this account for more than 24 trillion of dollars in capital market. And there are almost 1,000 organizations on the financial sector, actually, that represent almost 200 trillions of dollars of this. So it is TCFD recommendations are, I think, are in a really good moment. They are obtaining support from more than 100 countries who right now are discussing whether these recommendations could be partially mandatory or mandatory. And some countries already decide that, like UK, Korea, Australia, etc. But other countries, like you said, in LATAM are already discussing this, and because of their different processes that they are leading locally. In Mexico, sorry, not Mexico, but in LATAM, we have currently almost 79 members. From these 79 members, the 46% belong to Brazil, 25% belong to Mexico, the 10% belong to Chile, and 9% belong to Colombia, and the rest are split among the region also. So as you can see, there is not a huge membership right now of supporters around TCFD. However, since last year, I got involved on TCFD Secretariat and being a member. I started receiving a lot of interest from different associations and companies, financial, non-financial companies that are willing to learn and want to be involved more on TCFD recommendations. They want to start building on this agenda. However, also I think, and that takes me to the question, and the last question you posed, is that I think there is so much we need to do right now in LATAM to support this agenda. And that comes from all the ranges, all the perspectives that you can say. So if you take these numbers that I shared with you, it's like 3% of the global data of the total number or less it belongs to Latin America. So what does that mean? That there is not so many adoption right now. And there is, I think, also from my experience, there is some kind of fear, because there is, it's not easy to understand what the TCFD recommendations are mean in terms of your reality. I could say that, and I can say that from both perspectives, from the private sector perspective, where I work a lot, but also after looking into the work with some development banks in Mexico and talking with others in Latam, I can tell you more or less the same. There is some fear into getting involved into TCFD, because they don't know what does that mean, how far they can go, if they have to go for the whole piece of the recommendations, or they can start at certain points, and so. There is a huge discussion around this, and like I said, there is some fear around. So, yeah, we can leave it there.
Okay, I think that that last point is very relevant because in actuality, what is happening is that as I mentioned before, the supranational organizations are using the TCFD recommendations and principles to incorporate them in the larger bodies that they are constructing right now. So probably we will see more developments in the foreseeable future. Thank you, Alan, for this first question. Now we will move to our last panelist. His name is Gianleo Frisari. He's a climate change economist who works at IDB. He focuses on climate change, sustainable investments, to identify solutions for the mobilization of private capital. He works on financial instruments for the public sector, such as sovereign green bonds and so forth. And he is working also in integration of climate change consideration in topics such as financial regulation and supervision. Gianleo, you have been working on the construction of the guidebooks for FDIs. Could you please explain us how IDB plans to evolve on the climate risk agenda with national development banks in Latin America and the Caribbean as the guidebook publication, and what do they have to expect after this event also, because this is just the starter for something that's going to be larger than this, right? So go ahead.
Thank you, Diego. And as a proper research work, we always find a way to continue and to actually see that there is more research needed. The way we are taking this work onwards is really in two streams. One is governance and processes, and institutional strengthening. It's coming back to Alan's point, where to start is actually a pretty natural way to start on these roadmaps, because it's where the challenges are probably less in terms of like lack of information, lack of data, but it's also where the transformation from going from considering sustainability a niche aspect of the business to a core part of the business has to start. Governance is where all the information, all the evidence that can be gathered from modeling, from analysis, needs to be transformed in decision making. And in terms of governance and processes, we have a couple of things. We started again working together with Alan in Mexico and with the Banking Association. We've started and piloted for now 2 years a self-assessment tool for financial institutions, for banks, to understand where they are in the pathway towards TCFD, and especially how their operation already align to what is the framework suggested by TCFD, where the gaps are, and where, let's say, institution strengthening needs to happen in terms of changing of structure, presence of policy document frameworks in order to integrate climate risk into the decision-making process. Second, what we are doing now, and what we are preparing for the next months, we will start working with a few NDBs to prepare really templates, reference models for processes, how to structure, let's say, suggesting the working group that Diana mentioned this morning with COFIDE, how to structure this working group in the institutions, what should be the terms of reference for the risk management officer in a way to integrate climate risk, what should be the work of loan officers, what should be the questions from loan officers in order to integrate climate risk in the way they do business. It's a work we are preparing. The aim will be to really produce a reference model for processes and governance for NDBs, also taking into consideration the political mandate and the specific relationship that for NDBs exists between shareholders, governments, and agenda. On the second stream, and is where we are working right now, actually, on instruments and metrics. We've just launched last week a new pilot for which we are recruiting NDBs, creation of climate risk heat maps. These are portfolio tools to create areas of or to identify areas of vulnerabilities in the portfolios of NDBs, combining the public data that we have on physical climate risk, on hazards and chronic changes with the materiality, and this we will do at both national and subnational level. So we are trying to get to a significant downscale of the models. And we want to combine this with the exposure, with the sectoral sensitivity and materialities of specific factors in order to inform NDBs of what are the risk drivers in the portfolios, what are the transmission channels of these risk drivers to their clients, and then develop conceptual models that will couple risk drivers with resilience investments for risk mitigation. So allow me just one example to make it clear. Let's say we know there are areas in Latin America with significant water stress. Water stress as a risk driver can have materiality for different sectors: energy generation, agriculture, manufacturing. So we will try to understand these transmission channels and identify for each NDBs investment potential for drought-resistant crops, for water-efficient manufacturing equipment, or for water catchment in areas where it's possible. Hope that was clear.
Okay, thank you, Gianleo, and well, I think that this is very timely, and given that our national development banks in many of our jurisdictions are second-tier banks and work directly with the financial sectors, this is relevant and this is very important, and I cannot stress out sufficiently the importance of this publication for national development banks. We have some time restraints, so I will beg you, my dear fellow panelists, to be a little bit more concrete in the answers for the second round of questions. I will try to time you in somewhere around 2 minutes. This is a very complicated effort for all of us, but I will continue with Gianleo because I think that the question that I asked before leads us to another question, which is exactly what I was talking about, and is which special message would you send to those second-tier national development banks who work with the commercial financial sector in the region in terms of the tools that they can use and the use for the guidebook that we are launching today?
Thanks, Diego. And to be brief, I think there are two main variables in this aspect. One is financial development banks, as development banks, as a mandate, have a political responsibility to actually be there for the most vulnerable clients. So we, compared to commercial banks, we really cannot use risk curtailment as a risk management, but actually our mandate becomes stronger when clients become risky and become especially vulnerable and lose access to the market. At the same time, being second tier many times means that we are one step further from the client, and all information gaps, all data gaps become more significant, and especially cannot be solved by punctual intervention, by isolated intervention of a single credit line. This is where really a transformation of the institutions from the first loan officer who talks to the client to the risk manager who sees the portfolio needs to happen. And this is where we are, let's say, gearing all these instruments. And the idea of changing the processes from the bottom to the top and from the top to the bottom needs to happen in order to really change the way second-tier institutions deal with commercial banks and deal with clients, especially with SMEs where the information gaps is huge and disclosure is still a topic that cannot even be started.
That's very interesting, Gianleo, and I think that's a good take on the topic. I'll move now to Alan. Alan, 2 days ago we talked about this topic, and I think that this is very relevant. It is what they're calling enhanced disclosure. which is a conjunction of the IFRS 9 principles, the TCFD work from other organizations such as SASB and so forth, which is the base of what the supranational regulatory bodies are doing right now. But a lot of that stems from experience. And I think that your experience in this topic is relevant. Could you share with us any ways that you have seen that could help us in creating a better climate risk disclosure for a financial institution, like, for instance, the DFIs?
Sure. I think the work that is been happening in the supranational ecosystem is quite relevant, because it will help us to implement these TCFD recommendations, these climate management and disclosure recommendations, into what is already happening, and that's for sure. It will lead us to a better outcome now in the near future, because it will set that the same rules that are already applied will be adapted and will help the transition to be smoother in that sense. So the work that is being having with their value reporting foundation that was announced just a few days ago, it's quite remarkable. And by the way, IOSCO, the IOSCO, FSB, they all have been pretty clear around supporting the work that is happening on IFRS Foundation. So on the practice, what I can see is that what is happening on the reports that are being created by the financial institutions is that some of them are taking these reports outside their financial reports. Right? No. And I think this is really relevant. TCFD recommendations think and recommend that this topic must be taken into the financial reports. So we need to work on that more. In Mexico, we are trying to support and to create a similar work like the one is being held on Japan on the TCFD consortium. We are working on this idea to help to support what the institutions, the financial institutions and non-financial institutions can do, so they can learn from the best. They can learn from the best experience, from the best practice. They can learn from each other, also from the challenges that they have. So.
That's a very important point. There are always within countries leaders who are doing things first than others, and those best practices are really interesting. So, okay, now let's move to Remco. I want to go back to what UNEP-FI is doing all across the world and in our region. And there are lessons that we could take from that work in terms of identifying and measuring climate risks. Is there any take on that topic, even in data? You're muted, Remco.
Thank you, Diego. I mean, I think all of this, I keep on insisting that climate leadership in the finance sector is about risks. As I said, this was my main point: risks on the one hand, and then alignment and impact on the other. And one is financial stability and what the finance sector needs to do to ensure financial stability. The other one is climate stability and what's the role of the finance sector in achieving climate stability, basically achieving the goals of the Paris Agreement. So both need to be on the radar screen of financial institutions across the board, whether you're an MDB, a DFI, a national development institution, or a commercial bank, or a pension fund, or insurance company. Now, in terms of data, I think obviously all of this then boils down to data. And my recommendation to all financial institutions is that they need to get on top of data from two sources. One is the data from the scenarios, the forward-looking scenarios that tell you, what's likely going to happen with the world under different temperature outcomes. or they tell you what needs to happen with the world so that we limit global warming and we don't, pass, really dangerous thresholds like 1.5 or well below 2 degrees. And the scenarios are there. They just need to be interpreted, used by the financial institutions. They've not been developed from financial institutions. They've been developed, for academic purposes and for policy purposes, etc. But nevertheless, I think the challenge is the finance sector needs to be able to read those scenarios, to interpret the scenarios and use those scenarios. That's one thing. And then the other side of the data challenge is obviously understanding your companies, your clients on your portfolios, whether that's other financial institutions or whether that's other companies in the real economy or even households or projects and project finance. You need to understand how are those companies, projects, households positioned vis-a-vis climate change? Are those on a path to being stranded assets? Are those on a path to being compatible with the Paris Agreement and with net zero by 2050? And so not stranding. Obviously, that also requires data. And the problem there is there's plenty of data, say, in the public markets. So multinational companies, listed companies, they have CSR teams, they put that data out there, investors can read it. The problem for banks is very often they will be exposed not only to public markets, but of course also, SMEs, private markets. And the data there is like on climate data from an SME, it's not, it's modeled, it's sector averages, etc. And here, though, I think there's new approaches that are coming online where, the banks themselves, recognize they're the best. I mean, I'm talking banks, especially commercial banks here. They're the best position because they're closest to those clients in terms of raising that data from their clients, like they raise financial data from the clients. They can also raise climate proxy data. And I think that's really an avenue for progress and something that the bank should consider.
That's a good take on the question. And in practice, with Professor Engel and Professor Berner, who's here in this panel, we've been working with these governments, and one of the challenges has been getting the proper data to measure physical risks. And that creates the necessity of having interactions with other governmental agencies, and that creates a new level of interactions that the financial regulators and supervisors need to achieve. And that's something that is let's say interesting in the point of view, from the point of view of gathering the data. And that leads me to a question to Professor Berner, precisely about physical risks, because physical risks require the proper identification and location of, let's say, banking or financial institution financed assets. This has profound implications in the measurements of risks. Is there any advances in such complicated issue? For instance, in countries such as Brazil, large banks have investments all across and assets all across the country, and probably what happens in the southwest area of Brazil is different in terms of physical risk to what happens in the north. So this is a very complicated issue. So Professor Berner, is there any take on that?
Well, I would say, Diego, that as you know, this is a very complicated issue, as you just mentioned. I think it is actually one that is a good activity for NDBs and for supranational organizations to engage in, both to set standards and to help with the collection process. I don't think any individual financial institution has that capacity, precisely because many financial institutions operate in the same markets or in different markets. Each has a different portfolio, and not just the banks themselves, but also asset managers and lenders. And as Remco mentioned, some of the smaller enterprises may pose potentially pretty significant physical risks, which we don't know about because it's harder to collect the data from them. So this is something that I think would be where there has been some progress, but where it's very difficult to make progress, precisely because the variety of physical risks is high, and because the location of where those risks might occur is not only specific to the risk, but also sometimes, random, like the impact of flooding or hurricanes or so on. If I could take the time to make a couple of additional points, though. One is in response to Remco's statement. I don't agree, actually, that financial stability and climate stability are necessarily two separate things. If we want to mobilize capital to achieve our sustainability goals with respect to climate, then we need to have a resilient financial system. And so I think that it's very important to understand where the vulnerabilities in the financial system lie, particularly with respect to those being exposed by climate-related shocks, in order to understand whether or not we have the capacity to mobilize capital in the right direction. And that's true not just for banks and for NDBs, but for the financial system as a whole. But I welcome the opportunity, Remco, to work with you on thinking about how to gather more data on SMEs, and for that matter, in private markets. There are $7 trillion of assets in private markets or more, and rising very quickly. And we don't have a lot of visibility into where the exposures might be in those markets in order to answer pretty important questions. So the private equity firms who manage and control those investments, they should be sources of information as well, not just from the banks.
Thank you, Professor Werner, for the answer. Given that you mentioned Remco, I will give the chance for Remco to answer to what you said. So, Remco, please.
Very briefly, no, thanks for that, Professor Werner. I think on your last point regarding collaboration to, make it a reality that the finance sector has appropriate data also from the private markets. Absolutely. I think this is one of the big challenges ahead of us, especially for the banks, and just being able to do this assessments, set those targets, etc. In terms of your earlier point, I agree. I never wanted to imply that there's a choice that needs to be made between financial stability and climate stability. I think you can also argue if there's no climate stability, there's no financial stability, there's no stability whatsoever. There's no economic stability, etc. But and vice versa. I think the two to a certain extent go hand in hand. But you can be, my main point was around, you can be a bank that has all of its transition, so carbon related risks in check, has done a full assessment of those, has and is fully managing those. That doesn't mean that financial institution is enabling the low carbon economic transition necessarily. Because the extent to which a bank will only then move to, say, reallocate exposures from fossil fuels to renewable energies, as an example, if it believes that the transition risks affiliated with fossil fuels are too pronounced or too high to accept. The risk return doesn't add up, and at that point they might say, well, I get a better risk return from renewables. But that hinges then on whether the government in that particular instance is indeed intending or not to do something about those fossil fuel emissions, say via a carbon price or other such things. In the absence of that, in the absence of a government contemplating a carbon price, there's no transition risk from fossil fuels. And so you can have a very risk resilient portfolio that is not necessarily greening itself or greening the economy or helping green the economy by extension.
Yeah, correct.
So Diego, if I could just add one more point, and that is
30 seconds.
When we think about risks, as I mentioned at the outset, and as many have mentioned, we need to think both about physical and transition risks. And in fact, it may be that the biggest risk for financial institutions are transition risks. Yeah. And as a consequence, it's extremely important to think about them, whether or not the government is involved in doing the right thing to achieve the sustainability goals. If they're not, then that, to me, that may say in the short run, there are no transition risks, but it's pay me now or pay me later. And the longer we wait, the bigger the transition risks will ultimately be.
That's a very interesting point. And also I think that transition risks are harder to identify than physical risks because precisely they are not as present and are diffused a long time. And that's a very, very complicated thing to measure. So I think that the organization is telling me to cut, but I will give, because this is the point when everything was getting interesting, right? But I would just give 30 seconds to each of you to express your last ideas in these terms. If you had the chance of finding a lamp and a genie comes out of the lamp, which would be the wish that you would do to that genie in terms of what is needed for climate risks to be properly measured by financial institutions? And I will start with Jan Leo, because Jan Leo is a very knowledgeable guy about these topics.
I will go with an unconventional one. My wish would be that MDBs would hire climate people to staff properly and invest properly in the people to do this work. Because that's, I think, is going to be the game changer when financial institutions internalize these issues in their own human capital.
Yeah, that's a great question, a great answer to the question, Jan Leo. Now I'll go with Alan. Alan, what's your take on the genie wish?
Sure, I think what I would like to see is people learning and being open to listen and to understanding that this is not just tree hugging. This has to be with the transcendence of your institution, of your country, of your community. And social aspects are not fighting with environmental aspects. That's all.
That's a great take on the issue. Remco, your take on the answer with the genie.
I think I would want the finance sector to really, want to be part fully of what we need to avoid the ultimate existential risk from climate change. So to be a part of the journey to limiting global warming to well below 1.5. What I think is needed is that all of the CEOs of all of the financial institutions, whether public, private, whether public, private markets, lenders, equity providers, whatever, that they commit to transitioning their portfolios to compatibility with net zero emissions by 2050. They can make that commitment today. 161 financial institutions have already done so, as convened by Mark Carney in the Race to Zero. And there's no reason why that couldn't be thousands of institutions from around the world.
That's a very, very great wish. And last but definitely not least, Dick, give us your take on this one.
Thank you, Diego. My genie is the most challenged of all, because the genie would be required to get all the political leaders in the world together and agree on the sustainability goals that everyone in this conference seems to embrace, and to get them to commit together, to work together, to embrace those goals and to empower people to make sure we have the right disclosure and the right analytics, and then put in place the right policies to work towards those goals.
That's a very aspirational wish, but I think that the circumstances will force those political leaders to converge towards climate change policy. So this has been a very interesting panel. I think that as you see, we have a lot of work to do. I think that it is very relevant for financial institutions to hire those people who know about climate and ESG risks. It's relevant. I think that the take of Jan Leo was very important for what it has to do to the realities of our financial institutions. And also, I think that the genie might concede all of our wishes in the future, and mainly the most important thing for now is being able to identify the risk and to understand that the risk is there, and that is part of the financial stability of financial institutions. So that has been a really interesting panel. Thank you all. And now I leave it to the organization to continue with the event. Thank you very much all.
Thank you. Thank you, Diego, very much for your valuable coordination of this important debate for the future agenda for NDBs on climate risk management. We wish we could have more time to keep up. Now we're heading to the end of the webinar, and I invite you for the wrap-up session, convening the IDB and representatives of the DFI's community. First, representing the World Federation of DFI, I introduce you to Mr. Helmut von Glasner, Secretary General of the European Long-Term Investors Association. Mr. von Glasner, thank you very much for your presence here.
Yeah, thank you very much. On behalf of the World Federation of Development Financial Institutions, I would like to thank everybody who presented today and discussed today about these important topics. For me, it was very insightful and informative. We had very rich presentations and discussions, and I think the last session underlined this even more. I'm very happy that climate change, which is a global challenge, that this is treated in the regional context, because we have to do it on the ground, and national promotional banks and institutions, the development financial institutions, they are a front runner in this. I don't know how you feel after this long morning, but I'm quite optimistic that we can really come together and push forward with the ideas presented today. Tackling the risks associated with climate change and adopting the Guidebook's principles may not be simple and straightforward. They are challenging our traditional way of doing business. They are challenging how we even think about doing business. But we are beginning to make progress. There's still much work to be done. However, with this comprehensive tool, such as the Guidebook presented by the IDB today, we don't need to be intimidated. We don't need to bite off more than we can chew either. We can take small steps by laying out and then actioning a plan of the incremental adoption of these principles, integrating them into the policies that drive our institutions. It will be worth to build resilience, protecting our clients and our capital from the potential devastating impacts of future climate-related crises. And how better to set an example and pave the way for the rest of the industry to follow suit than national development banks. On behalf of the World Federation, I encourage all national development banks to take climate action now. Begin integrating climate risk into your governance, strategy, and risk management. This is necessary immediately, and contribute to the public disclosures and reporting on climate risks. As public policy instruments with a mandate to contribute to positive societal impacts, national development banks should be systematically identifying, assessing, and managing climate risks and opportunities in their own operations, asset allocations, planning, and portfolios in the order to continue the fulfillment of their mandates. National development banks play a critical role in supporting their respective governments to achieve climate goals and commitments. Between nationally determined contribution and mobilizing funding, financing forwards climate adoption to help close the gap. Through the risk management and government support, national development banks can benefit from better managing their asset allocation to align with the transition to a low carbon and climate resilient economy. We should consider the potential of new funding from a variety of sources, given that international investors and financiers are increasingly aware and calling for climate risk management. National development banks should also be publicly signaling their support for combating climate change and building resilient financial systems. It will contribute to the demonstration effect by setting an example for other key players giving national development banks unique position in local, regional, and national financial communities. My hope is that each of you take this guidebook back to your institution and start looking at how to approach climate risk from a new perspective. Let me tell you that many DFIs, and notably small organizations, are struggling with a roadmap ahead of us. That's what we see here in Europe quite intensively. So reach out to your connections and to other institutions, as recommended several times in the presentations today, and ask them what other national development banks are doing to address climate risks. I suppose that ALIDE is a useful platform in this sense. Knowledge exchange and cross-fertilization is so important to succeeding as a collective. We must continue to share our experience to uncover best practices for implementation. Let's work together to drive this change home and create a better future for all. Thank you very much.
Thank you, Mr. von Glasenapp. Highly appreciate it. Now, representing the Latin America Association of Development Financial Institutions, ALIDE, I now introduce Mr. Edgardo Alvarez Chavez, General Secretary. Mr. Chavez, a pleasure to have you here. Thank you.
Thank you, Rodrigo. Dear friends, good morning and good evening to all of you. We are about to reach the end of this interesting webinar. We have had remarkable presentations and the launch of the Guidebook for National Development Banks on Climate Risk, developed by the IDB, with a group of experts for subsequent application by the NDBs, whom I thank from ALIDE, the Latin American Association of Financial Institutions for Development. Now let me briefly express some ideas about the action of NDBs, the challenges and commitments to sustainable development mentioned before by Stephanie, Maria, our colleagues, and from ALIDE's points of view. This pandemic has caused an unprecedented economic and social crisis around the world. Latin American economies face this crisis by dragging a series of unresolved structural problems that have been intensified, such as informality, lack of social protection, and low productivity. COVID-19 eventually highlighted the serious deficiencies and fragility in the health and education sectors. Since the beginning of the health crisis, the NDBs in Latin America and the Caribbean had implemented measures to mitigate the negative effects caused by the pandemic. Thus, they have granted new credit lines for companies in sectors such as health, industry, agriculture, tourism, SMEs, foreign trade, new loans from families and some national governments, and so on. And in this regard, in 2020, the NDB's credit portfolio from LACs had increased in almost all countries, in line with the countercyclical effect on these entities in times of crisis. But as we know, and it was mentioned before, we need to attract more private investments and to measure the impact. And this is very important. We really need to measure the impact of the activities and we as development banks are doing in our region. Also, in the infrastructure point of view, the new infrastructure must be climate resilient in a way that ensures that it is built and designed for the future, and thus reduce the high cost of increasing recurrent and more intense natural disaster, as well as in the generation of energy from renewable sources to be energy efficiency, among other items. With regard to climate change risk in their portfolio, the financial sector also have a key role to play by addressing climate change challenges with foresight, and to do so by integrating climate-related risks and opportunities in capital allocation, decision-making, and financing the low-carbon and climate-resilient transition. As mentioned in the guide, the NDBs play a central role in the Latin American and Caribbean financial sector. As such, they have the potential to mobilize and orient capital toward activities, contributing to the goals of the Paris Agreement and the Sustainable Development Goals. To this end, and to successfully fulfill the development mandate, it is critical that NDBs systematically identify, assess, and manage the climate-related risks associated with their transactions, portfolios, and operations. NDBs, as financial institutions, need to be ready to address the potential impact on their existing and future portfolio and financial positions, They need to reevaluate the concept of risk and incorporate climate change into their strategic planning and financial decisions. This guidebook for national development banks on climate risks, provided by NDBs with a roadmap to integrate climate-related risk and opportunities in alignment with the recommendation of the Financial Stability Board, the Task Force on Climate-Related Financial Disclosure, it will undoubtedly be a available tool for NDBs to be carried out the work in the financing green and climate change related projects. In this sense, we highlight the effort that the IDB is making by sharing it with ALIDE and the NDBs globally by inviting the World Federation in the name of its president Thabo Taman and having the European Loan Investment Association represented by Helmut. To conclude, I would like to thank the IDB in the person of our great friend Juan Ketterer, Division Chief, Connectivity, Markets and Finance, with whom I hope to continue working together for the progress of the countries of Latin America and the Caribbean. Thanks a lot and have a good day.
Thanks so much for your inspiring words, Edgardo. We appreciate this long-term cooperative work with ALIDE toward more effective engagement of NDBs in this important agenda. And for our final remarks, I invite our Chief of the Connectivity, Markets and Finance Division at the IDB, Mr. Juan Ketterer. Mr. Ketterer, you're welcome again. The floor is all yours. Thank you.
Thanks, Rodrigo. Well, thank you all for being here. This is it's already late hour in the afternoon here, and maybe late in the evening in Europe. So thanks, Helmut. Thank you very much, dear friend Edgardo, for your support, not on this particular webinar, but always in so many years that we've been working together. Thank you, all the rest of the people of the IDB, Maria, Rodrigo, and all the rest of the people that have been material to organize this webinar. I don't want to take too much time, but I just want to say that this is our endeavor is an important one. I think this is one of the most important ones because the future of our planet depends pretty much on it, and we have to hurry. There is no much time. There is some time, but there is no much time, and all the decisions we make today will have an impact in the near future. So I encourage you to be thoughtful and deliberate in handling these issues. We have recently launched several initiatives. One of the most important ones is the Green Bond Transparency Platform that we hope that you can all visit and use, because it's an important tool for the development of the climate financing. And I wish you well. I wish you the best. And I think that today is an important step towards this end of addressing this important issue of the climate financing. So thank you very much to you all again, and we'll see you around. Thanks. Bye.
Thank you all for participating in this event. The recording of the webinar will be available at the link posted in the chat on the right side of your screen, and so is the guidebook for download. Stay well and safe. Goodbye.